Silver Lake. The $13 billion buyout follows through on plans announced back in October. Endeavor, led by Ari Emanuel, said at the time it was evaluating strategic options out of frustration with the company's declining stock price. Women's college basketball has a new TV ratings record. Monday's highly anticipated rematch between the LSU Tigers and the Iowa Hawkeyes drew over 12 million viewers, according to ESPN. That makes it the most watched college basketball game in the history of the network and tops viewers for last year's NBA Finals and baseball's World Series. Iowa star Caitlin Clark led the way for the Hawkeyes with a dominating 41-point performance on the way to an Iowa win. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, commodities waking up.
We have been saying that we are going to be breaching $90 in the summer. If anything, that's come a little bit earlier. Prices have lagged what the physical has been telling us for a good 3 months now. But now, really, we are starting to see that catch up.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Jobs Day, and Bloomberg has the report under surveillance.
Job numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Live from New York, equity futures just a little bit softer, negative down, lower by 0.14% on the S&P 500. Yields a little bit higher by a single basis point. At the moment, 436.12 is your yield on a 10-year in the commodity market, getting closer and closer to 86 on WTI, 85.79 and positive 0.75%. Under surveillance this morning, commodities waking up.
We have been saying that we are going to be breaching $90 in the summer. If anything, that's come a little bit earlier. We have seen inventories not build or even draw counter-seasonally in Q1. In certain months, the physical market continues to remain very, very strong. And you're just seeing finally that being reflected in prices. Prices have lagged what the physical has been telling us for a good 3 months now. But now really we are starting to see that catch up.
Here's the latest this morning. Brent crude nearing $90 a barrel amid increasing Middle East tensions and expectations that OPEC Plus will keep production cuts until June. Ed Morse of Hartree Partners and formerly of Citi saying this: there is a growing consensus that supply and demand balances are tightening for the next couple of years. There is a tendency to overestimate the demand rebound and to underestimate the supply response around the world if prices get too high. Ed, I'm pleased to say, joined us now for more. Ed, wonderful to catch up with you, sir, in your new seat. Let's just talk about dynamics that are taking crude back towards 90. Ed, what do you think is underpinning this move? Because there's lots of different things happening at the same time.
I think what's underpinning the move is financial markets, to be frank. We've seen increase in call buying. This has happened over time. The market was short at the beginning of the year, given what happened last year, with prices going down at the end of the year rather than going up. Then it became a little bit neutral. And now with the rise in tensions in the Middle East, there certainly is an increase in call buying for Brent. We're seeing an increase in calls at June at 100, July at 110. So I think this is basically the risk factor in the market more than it is supply and demand balances at the moment.
I love this line from you, Ed. There is a tendency to overestimate the demand rebound and to underestimate the supply response. Can we talk about that second line, underestimating the supply response? Can you tell us how strong that Saudi appetite is to withhold barrels from this market as crude gets back towards 90?
Well, the Saudis would love to have a $90 price, not going to 95 or 100, and not going much below that. But you can't really manage a market to that degree. An intriguing thing about OPEC is they just had a seminar, an educational seminar that I think went very well. They had some of the most significant specialists in how derivatives markets work making presentations to them, so they have a much better, not cynical understanding, but a real deeper understanding now of the dynamic effects between financial flows in and out of markets and the balances. So let's hope that they take that to heart. But for your answer on the Saudi question, $90 would be the perfect number if it would be stable for a long period.
You wrote also, this is about as risky a market as one can imagine, and it is only recently that risk is being priced in. Based on what you just said, I'm not completely clear on which the bigger risk is. The idea of so much more supply coming in that prices tank, or that you get demand that continues to be consistent with a possible disruption that causes prices to surge. Which is it?
Well, it's both, and they have different timing. There's no doubt that physical risk in the market is about as high as it has ever been without really massive disruption taking place. We have, looking at the Fragile Five, Iran, Iraq, Libya, Nigeria, and Venezuela, we have concerns about where production will be in all of them. In addition to that, we have concerns about Mexico and Russia, particularly with the bombings by Ukrainian drones on refining capacity. So it's a physically risky market. On the other hand, when we get prices going up, there are changes that take place in the market. China stops buying when prices get above 90, and they start drawing inventories. Their inventories are way, way high. They cover, in our estimate, about 105 days of forward demand. That's as opposed to the 90 days of export cover that the IEA countries have. And they've shown over the last several years that they do buy low and sell high. So we get high prices. China will not be buying from Saudi Arabia and from other Middle East countries as much as they have been lately. We have the U.S., which has already decided to stop the fill of the SPR, which aims at doing that when prices are below 80. And now forward curves have gone up, and they can't buy at below 80, so they've suspended the purchasing. We don't know whether they'll be increasing. We have a remarkable change in the U.S. Market itself in terms of the consolidation of the Permian Basin and other basins. We have large publicly traded companies that won't hesitate to increase expenditures in the short run if they can benefit. So we have high prices in the summer. If they're sustained, let's say for 3 or 4 weeks, I think we'll see the publicly traded companies coming back. And I would not be surprised if instead of an expectation of a 600 to 800 barrel a day, 1,000 barrel a day increase in U.S. production deck over deck, we'll see 1 million, 1.1 million. Yeah. We're already seeing U.S. exports skyrocketing. So we're in a very different market where reaction is faster than OPEC Plus's record.
And if you could quantify the uncertainty, I'm thinking of a range. How big is the range that you're looking for in terms of some sort of price on crude as you look to these two-sided risks on all sides?
So I'm looking at a $70 to $95 range. That's a wide range, but that's what we've seen in the market over the last couple of years. We've seen distortions, and as those distortions work out, the market recalibrates and goes down. We had a massive distortion in Suez and in the Red Sea and in flows between Europe and west of Europe through the Suez Canal from the Middle East. That is now adjusting. Freight rates are adjusting. So we're seeing the distortionary impact actually cleaning up even as we move into summer. So it's a much more complicated market than we've ever seen before. And you can't even look at inventories, which is among the most misleading data points that people are now kind of parading out. People are comparing where inventories are now, where they were a month ago and a year ago. That's not the point. The point is that we have to look at inventories discretely. We have to look at them in terms of days of forward cover. If we look even at the U.S., where people argue that we're in a market which is showing tightness on the gasoline side, days of forward cover of gasoline are the third highest of the last 3 years. So it's not like, that's like more of an average market than it is like a market with low inventory. So we've got to get used to a new set of indicators as we look at markets and help us make judgments about where prices are likely to go and where the trading community should be going.
Ed, we talked a lot about supply. I want to talk to you about demand, because you have a contrary view in terms of you actually see peak demand happening in advanced economies. Why?
Well, it's easy if you look at them one by one. The European economy has certainly been deindustrializing at a fairly rapid rate. They've adapted policies at a fairly rapid rate to reduce the number of fossil fueled trucks and cars, and demand across Europe. We don't have high-frequency data that really tell us much. We have high-frequency data from Mediterranean countries, which are in a healthier mode than Northern Europe, where we have a 2 to 3 month lag. So even IEA data lag in terms of high frequency, other than in areas like Amsterdam, Rotterdam, where we get high frequency weekly data on inventories, but not on critical supply and demand. On China, as I remarked to you in the notes I said, we have high demand on a year-on-year basis. But if we look at the last 6 to 8 months, demand has really plateaued. And that goes along with everything we know about the Chinese economy, what we know about EV penetration into the economy, what we know about growth, which I think is, again, one of the most misleading indicators. We have China claiming they had 5.3% growth. We have the IMF indicating China this year will have over 5% GDP growth in China. The reality is that if you talk to Chinese specialists and Chinese economists in China, they will tell you on the side that GDP growth was not 5.3% last year. It was more like 2.5% at a peak and might have been even lower than that. So we have GDP that's stagnating. We have incremental buying pushed by the government of electric vehicles, displacing fossil fuel vehicles. And then in the U.S., if we look carefully at gasoline demand year to date, we had, with January close to final data, virtually no demand growth. It was stagnant year on year. The same is true of February on a 4-week moving average basis for the data we have for February. And we'll get the third week of March in the data later this morning. But yes, we did have an increase in gasoline demand in the last 4-week moving average numbers. And we'll see how sustainable that is, how seasonal that is. But what it is, more than anything else, is kind of a misleading number compared to the historical level that we've looked at over the past several months.
Ed, when I get home later, I'm going to re-listen to this conversation. Really, really interesting. Ed Morse there, of Hartree Partners on the commodity market. Brent crude at the moment, 89.60. Lisa, 85.82 on WTI.
Most dangerous market he's seen in a long time, given that there are very two-sided risks and hard to really get a gauge with new metrics kind of signaling how to look.
Coming up next on this program, President Biden escalating his criticism of Israel following the deaths of 7 aid workers. That conversation is coming up next with U.S. Marine Corps veteran Elliot Ackerman from New York. This is Bloomberg.
The way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
to raise my confidence.
That conversation just around the corner, live from New York. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
My general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
long term, we're sticking to our guns. I'm looking at the 20-year today at 460, and this is what we're advising our clients. If you have a long-term time horizon, 3 years and out, you're supposed to buy long-term interest rates here. There is value. They'll probably be lower in 3 years from now, but it's really the next 6, 12, 18 months that we're hedging our bets.
How much is that complete faith that the Federal Reserve will be overly cautious in terms of how quickly they'll cut rates? In other words, if they don't really follow through on that, and they do cut rates in June, despite some of the strong data, would you move away from that long duration view?
No, I think if they cut rates sooner, it even emboldens the view that those long-term interest rates in the mid-4s are too high, right? Looking at the 5-year markets pricing of what the Fed funds rate is going to be, Lisa. So that's like a really term expectation of the funds rate. It's at 380 today, all right? So the markets are only pricing in about 160 or so basis points of cuts forever. Right, and that's really why we have a stronger viewpoint on the longer-term value in Treasury yields right now, because I think the Fed funds rate is probably going to average well below 3.8% a year for the next 10 years, right? And we're just really debating, the next 6 to 12 months. But wow, over the long term, global growth is slowing. China is really struggling. You're seeing inflation in Europe continue to decelerate, right? So, there are big picture signs globally that growth is going to continue to moderate and that inflation will ultimately come down. It's really the challenge has been in the U.S. data.
Which is interesting because this is one of the key nodes of debate, which is basically, are we in a new regime post-pandemic of higher inflation, or to your point, are we not? Would a possible policy shift change that? The potential for a more aggressive protectionist type of policy with higher tariffs and more sort of nearshoring and onshoring of production?
Yeah, the world, Lisa, had been pricing in, and according to our models, the markets were pricing in almost 100% probability of this really, weakflation, soft landing scenario. And we thought, that was too aggressive, meaning risk assets were maybe too ebullient, too optimistic. One of the big risks to that scenario is obviously heightened geopolitical risk. As you point out, the political reaction to that, the stickiness of inflation associated with that, and you're seeing obviously things like oil jumping here, but even some of the commodities that have underperformed, like lumber, natural gas, iron ore, are bottoming out here. So you could have this kind of bounce in commodities associated with some of the geopolitical risk, which leads to stickier inflation, which leads to a Fed that is forced to hold rates higher. And to us, that's a risk to the markets. That's a risk to the economy. That's a risk to credit spreads, if you will.
Well, let's talk about credit spreads. High yield spreads, a little bit wider, still in at around 300 basis points, near multi-year tights. Mike, a question we keep going back to on this program, is that tightness a reflection of strength or complacency? How would you describe it?
It is a little bit of both. The fundamentals, Jonathan, in the credit markets, the fundamentals of corporations around the world are actually still really robust. We've expected profit margins to really come down. They really haven't. Profitability isn't great, but it's okay. Companies have done a really good job managing their balance sheets and their liquidity, and these higher rates really haven't hurt them so much. Credit default rates are not going to surge in our estimation. It's hard to say spreads are cheap here. It's probably even hard to argue that they're fair value, but we have seen in past cycles, and I've certainly lived through a lot of these, where credit spreads narrow, and they stay at these really narrow levels for a long time, years in some cases, and who knows, we might be in one of those environments. But we also have learned that the tail risks are significant, that when credit spreads do widen, they kind of spike wider, and it could be any exogenous shock out of the blue, including the risks I just mentioned. So it's definitely prudent to cut risk here. We are doing that. We are selling into this rally. We've been doing it for a while, continuing to play defense to some extent in the credit markets. But one thing you're seeing, Jonathan, with these credit spreads, Treasury yields are high, right? The premium of a Treasury bond over SOFR, which is theoretically the real risk-free rate, is very high. So there's already this big supply premium in Treasury. So maybe it's the risk-free rate that's too high, and the corporate bond yields are at the right level. So I think the spread, there's this technical aspect to it, right? There's a ton of supply of Treasuries and not a lot of supply of private sector credit debt. So that in and of itself causes these credit spreads to remain narrower than you would expect.
Mike, this was a clinic. Next time, get in a car, go through the tunnel, get from New Jersey to New York, and we'll do this around a table for a whole lot longer. Michael, thank you, sir. Michael Collins there from PGIM. Love it. Thank you, buddy. Absolute clinic. Coming up on this program, up next, Steve Whiting of Citi, former House Majority Leader, Eric Cantor, and Mandeep Singh of Bloomberg Intelligence, the third hour of Bloomberg Surveillance. Up next.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park. And that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Fed is telling us that inflation is still a problem. It's going to be less rate cuts relative to what the market was expecting.
I think the Fed have been really clear that they're looking for progress on inflation.
Not only has the market moved away from a Fed cut in June, the market's not even fully pricing in
the cut in July.
Actually taking no action right now is probably the best course of action for them to take instead of making a mistake.
They want to give the market what it wants in the form of easier policy, but the risk is overdoing it to the downside.
This is Bloomberg Surveillance with Jonathan Ferrell, Lisa Abramowitz, and Anne-Marie Hordern.
Quote of the morning, nothing comes close. Nothing will beat this, from Michael Brown of Pepperstone FX on Twitter. ADP due shortly, so we can all see what the NFP number won't be on Friday.
Which is the reason why we are...
ADP, just around the corner.
Yeah, we heard that from Pantheon Macro as well, right? Deeply unreliable, which is what we're going to wait for when people start to trade on it. We'll explain why.
What is it about pouring cold water over labour market data at the moment? Andrew Honhorst of Citi out with this note. Jolts bring little new information. ADP out this morning, not a reliable indicator. Going into payrolls on Friday.
Because when we get the data, everyone afterwards explains why it doesn't matter and why it's relevant and why their theses still stand. Again, this goes to this question of if you have an ultra data-dependent Federal Reserve and then everyone discounts the data, what are we really hinging a lot of our ideas on?
The only time it ever really gives a good preview to NFP, it's totally off of coincidence, but the Fed uses ADP data for their own private statistics. So in that sense, I do find it slightly interesting.
Citi does say this, important to look at the ISM services and employment subcomponent coming out a little bit later today. And they're looking for this on Friday, and I think we need to get into payrolls Friday just a little bit more this Wednesday. They're looking for a below consensus 150,000 job growth on Friday. I think this is really important. Over at Citi, they believe the emphasis has shifted to a greater degree away from inflation and towards payrolls on the FOMC.
And they've been expecting weakness for quite a while, and they pointed to the fact that Loretta Mester, who's traditionally been of the more hawkish ilk, coming out and still supporting 75 basis points of rate cuts, even if she says that she needs more information. It seems as though there is a cadre of people, including most of the people on the FOMC, that believe that we will see weakness, and that believe that we are starting to see signs of it in certain corners with quits rates that are at the lowest levels going back to 2019, although pretty much stable. I'm just struck by how much disagreement there is on the basic structure of where we are. Whether it's Margie Patel, New Era, Michael Collins, Nope, Ed Morse, riskiest time ever, huge range, Eric Vail, basically enthusiastically neutral. It is a confusing moment where people really are not getting their handle on any kind of consensus of the new normal.
Confusing, so it makes it hard for consensus, but going to payrolls on Friday, Jonathan, you brought up a great point. What is deterioration in the payrolls market? If it's a two-handle, how can they say that is deterioration in the labor market and give them an impetus to want to potentially cut rates?
The 200 looks pretty rock solid to me. 214 surface level stuff looks pretty solid. Hard to disagree with that. The previous number 275. Sometimes the news is that there isn't any, and I think on the FOMC that's what strikes me about the communication so far. There's been no change from them for 3 months, even though you've seen this big swing, this massive squeeze develop in the market. They've barely moved at all. And just the way I responded to listening to Mary Daly yesterday, just sitting there, and I've repeated this a few times this morning, I know, but I was sitting there yesterday listening to Mary Daly talk about 3 cuts in 2024, and I just thought, wow, super dovish, 3 cuts for 2024. 3 months ago, I'd be sitting there saying, 3 cuts compared to where this market's at. How are we going to close that spread without causing all this damage in the market? And here we are. Stock's still just off all-time highs.
I want to offer up an apology because I've gotten a lot of messages from people saying it's you that have been wrong in terms of the whipsawing of the, oh my goodness, they need to cut 7 times to, oh my goodness, they're not going to cut it all. The Fed stayed the same and they've been right, and the market's kind of moved toward them. As Mary Daly said, it's a projection. They change with the data. Of course, now we're undermining with this question of the data. So the labor market report will be one data point that we will be watching.
Yeah, they say they change with the data, but you said every single data point is just recalled an aberration or a bump in the road if it doesn't suit the trend or the thing that they're looking for. And I take issue with that at the moment.
I would agree with that. I also think that some of the manufacturing resurgence that we're seeing has to get their attention because we were expecting manufacturing to remain suppressed and then services to come down and meet it. And we haven't necessarily seen that to the same degree. If you have manufacturing inflation picking up and services inflation kind of remaining sticky, that creates a hairier situation.
And it's not just manufacturing at home, it's manufacturing abroad as well. China too. We'll get to the commodity market in just a moment. Equity futures at the moment trying to recover, just about unchanged on the session on the S&P 500. Brent crude and WTI starting to move higher. A move of 1% on WTI. We reclaim 86. On Brent crude, 89. 82 this morning, Anne-Marie. Crude bleeding higher again by 1 full percentage point this morning.
Yep, 1 full percentage point. This comes on the heels of not just the geopolitical risk we've seen into the market the last 48 hours, but OPEC Plus. We're not going to add any more supply to this, and they went a step further. Those cheaters out there, please come in line with what you agreed that you were going to cut in terms of supply. Fascinating going to the summer. We're going to have peak demand, Jonathan. Are they going to have to come in and help support this market?
That move in crude pushing yields up a little bit as well, up an extra basis point. The 10-year getting closer and closer to 440. Bear in mind where we closed out last week at 420. Closing out Q1, 420. Just a few days into Q2, very close to 440. Coming up this hour, we'll catch up with Steve Whiting of Citigroup on why he thinks this is close to an ideal setting for financial markets. Former House Majority Leader Eric Cantor on the ballooning US deficit, and the brilliant Mandeep Singh of Bloomberg Intelligence after an earthquake strikes the global chip-making hub of Taiwan. We begin with our top story. The rally that took stocks to record highs is taking a breather as rate cut expectations continue to fade. Steve Whiting of Citi Global Wealth saying this: the combination of lower policy interest rates, slowing inflation, uninterrupted economic growth, and rising corporate profits is as close to an ideal setting for financial markets. Steve, I'm pleased to say, joined us now for more. Steve, let me go through that quote again. So this is what you said: lower policy rates, slowing inflation, uninterrupted economic growth, rising corporate profits. Close to ideal. Couldn't agree with you more. But is that what we have right now?
That's what explains the last 6 months. That's what explains a 24% rally, over the course of 2 quarters. So that's what we want everyone to bear in mind, that we've had this really, really strong run with low volatility. We've checked the boxes on that whole list. So naturally now there's some more doubt. Again, we could talk about what the Fed actually does, what data they will require. We can zoom out a little bit, but it's a little bit more natural now for us to develop some doubts about, this very, very perfect path that we've been on.
So, Steve, how does that sort of doubt get expressed in your view if you think that ultimately we do see a pretty strong backdrop and ultimately this sort of perfect landing, this disinflation nirvana will continue?
Well, I think, again, the rates market having a bit of a backup here, we think that long-term treasuries, again, very efficiently priced in Fed rate cuts. And at the high of this year, they're pricing in almost 7 rate cuts this year. Now they're going all the way to having doubts about any cuts this year. In reality, the Federal Reserve has clarified, again, with its forecast, with its history, that it doesn't need, again, a collapse in the economy to move back from highly restrictive monetary policy to a more neutral setting, given some time. And that this is not a crisis that it's going to take for the Federal Reserve to cut a little bit. But the market's got to digest this. And the fact that we've had predictably a higher inflation for the first 2 months of the year, and there was no reaction to this. Now, again, a little strong data, and we take a little bit of wind out of the sails of the bond market, and then this feeds through to the equity market. So again, it wouldn't be surprising if the equity market feels it a little bit more. Again, in terms of strategy at Citi Global Wealth, we've moved a little bit more towards areas like healthcare that are not quite as reliant on really, really low interest rates. I think, to power valuations higher. And nor have we gone and really added even more to cyclical industries, which have rallied on expectations of growth. So that very, very good backdrop we've had, we could have been even more bullish. And we're just tempering that a little bit here and holding in.
Steve, I'd love your take on what we've been hearing all morning, which is completely different views on where we are going to settle in terms of the post-pandemic norm. And I just want to get your view about whether you view that disagreement as healthy and encouraging your view, or whether it kind of keeps you up at night. That what if we are in a highly inflationary environment in the post-pandemic reality where rates are not going to come down all that much versus going back to what we were used to pre-2019?
Well, look, if it was a highly inflationary environment where we have a truly overheating economy, where the labor demand just exceeds supply at an accelerating level, we'll find a way to have a recession then. And I don't think that's going to be the case. When you shifted to a bullish posture on the outlook for financial markets, and then you see the consensus that, again, very much believe that we had to have an economic downturn and everybody get even more bullish, then you start to say, well, the problem is a bullish consensus. Now that we're hearing some disagreement, we're hearing all of these troubles arise that people are thinking, imagining. I think it's a little bit helpful here, again, to take out a little bit of the froth. The reality is that to get the continuation of this 10% per quarter type of rally in the S&P 500 would take even more positive surprises. It will take a larger drop in inflation and a stronger rebound in growth and profits. I think we have a pretty good picture, but we don't get to do 24% of 6 months, annualized 48%.
Steve, you talk about the possibility, though, of a near-term CPI surprise. Potentially that could be then a pullback of what we're seeing in the market. How concerned are you about the uptick in commodities influencing a surprise in CPI, that we do see a reacceleration?
So look, I think headline inflation had a nice assist from, oil actually peaked way back in early 2022, again, with the invasion of Ukraine. And we've had some ups and downs. These are familiar ranges. It certainly won't give us any near-term help on a headline CPI. I think that measured inflation, this piece of shelter that's still up 6% year to year, where the inputs for that looking 1 year out are coming down sharply. That's going to give us a year of measured core disinflation, particularly for the CPI reading, a little bit less for the core PCE. But that's going to be, I think, when realized, now that everyone's worried about inflation again, hopefully, that's going to give us, I think, a little bit of calm on the inflation front. What I think is really critical here is the employment pace. Just zoom out a little bit. I'm going to use rounded numbers, but if you go back to 2021, we did almost 7 million job gains as the rebound from the pandemic. We then slowed to 5 million. Last year, rounded, we slowed to 3 million. That slowing, I don't think, is going to stop. What we've seen with job openings, high levels, well, they're down 3.4 million. If you think about monetary policy with, the high end of the Fed funds rate at 5.5%, and the job market slowing, where will it be 6 months from now? It's slower than it has been. And I also say that these quarterly distortions, employment and inflation data, some of it, not the commodity prices, but pieces of the inflation data and employment data have been biased up by some difficulty with seasonals at the beginning of the year. What we saw in production and demand data biased down. I think that this can, again, move more favorably as we get into mid-year. And if we do get, again, a little bit more restraint on the employment front, we will calm down the bond market. Now, if that creates some worries in the stock market, maybe there'll be more opportunity after we get through that.
Interesting, Steve. We've got to leave it there. I know we've got some technical connections. We're going to work on your shot in the next few minutes, so don't go anywhere. Steve Whiting there of Citi is going to be sticking with us. Looking for some jobs data in just a moment. The ADP report, 150 is the estimate. The previous number, 140. Going into payrolls Friday, the estimate there for you in our survey is about 214. The previous number, 275. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara. Hi, John.
Taiwan has been hit by the strongest earthquake in 25 years. At least 9 people have been killed and more than 900 injured during the 7.4 magnitude quake on the east of the island. Rescue workers are scrambling to find 56 people who remain trapped after the earthquake leveled dozens of buildings. Intel shares are falling in pre-market trading after it reported losses at its factory network, saying that losses have deepened and the business may not reach a break-even point for several years. A new division at the company, dubbed Intel Foundry, which is responsible for manufacturing, recorded an operating loss of $7 billion in 2023. That's more than the $5.2 billion it posted the previous year. Sales also fell short at the unit with $18.9 billion recorded in 2023. That's down from $27.5 billion the previous year. Women's college basketball has a new TV ratings record. Monday's highly anticipated rematch between the LSU Tigers and the Iowa Hawkeyes drew over 12 million viewers, according to ESPN. That makes it the most watched college basketball game in the history of the network. It also tops the viewers for last year's NBA Finals and baseball's World Series. Iowa star Caitlin Clark led the way for the Hawkeyes with a dominating 41-point performance on the way to an Iowa win. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, ADP payrolls data ahead of Friday's main event.
We're probably going to see a somewhat slower growth rate in the job market. We're in a soft landing, but the overall trend in inflation is still going in the right direction, and that's the strongest argument for buying, extending duration.
The data up next.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Economic data out just moments ago. It's an upside surprise on the ADP report. Mike McKee, what have you got?
184,000 jobs were created in the month of March, according to ADP, at least, most of those in the service-producing sector. What's interesting is this is not only higher than the forecast of economists for ADP, it's higher than the forecast for jobs in the private sector for the payrolls report on Friday. Right now, we're looking at a private payrolls number of 170, so 184,000 is 14,000 more than economists were anticipating. Wonder if, given what we saw with ISM number changing people's views of Friday's total, whether we'll see that happen again, whether we get some upward revisions after this.
The median estimate in our survey has been creeping higher, Mike. It's got to 214 from 200K, I think, to start the week. Do you think that was ISM manufacturing just sort of waking everyone up on Monday to maybe a bigger number?
Well, you put that together with JOLTS and the fact that there were a lot of job openings. That's probably why we do get the ISM services numbers today at 10 a.m. That'll be important in terms of the number for their jobs index, and we could see this all revised up. We have been running a number of months in a row with numbers coming in higher than the Fed forecasts.
Welcome to Existential Wednesday, where we start to question what the data means and whether it's relevant, because that's exactly what we get from a lot of notes after it comes out, where people say, yeah, but this is a reason why you can discount it. What do you make of all these people saying, okay, well, the ADP is messy and noisy and never predictive. We're going to get the same kind of messiness with the ISM services. You could say that about JOLTS, and yet quietly under the surface, people are starting to trade with this expectation of more strength ahead.
Well, the traders are putting it together the same way the economists and perhaps the Fed are putting it together. You don't make a decision based on any one number, but when everything is coming into the same area. You know, it's the wisdom of crowds, I guess, wisdom of crowds of data, as opposed to the wisdom of crowds of people, or the old 50 million flies can't be wrong.
But do people say that the data now is less correct than it used to be, simply because of a lack of survey responses, because of transformed demographics, because of different ways that people communicate? And I don't mean to get too abstract, but I just gotten so many notes over the past 3 days challenging the accuracy of all of the data that we're supposedly dependent on, and I'm wondering whether that rings true to you.
It does. There is a problem with the response rates we're getting from a lot of the data points, and people just don't like filling out surveys anymore, it appears. It's the same problem they have with the political polls. But the statistical agencies are doing their best to try to adjust for that, and they're coming up with new ways of getting data. Some of the data, like in the CPI, they're using private sector data now for some of that, and they'll be doing more and more of that as this goes on, because the government certainly doesn't have the money to do a complete rewrite of all its surveys.
When we hear from Jay Powell today, do you expect anything different given the fact that we have an upside surprise of ADP, we had ISM picking up? There's some smaller data points that he can talk to that we didn't have when he spoke on Friday.
Well, really, the data points we have are in the labor area, and he hasn't been concerned about the labor market. He's been talking about a strong labor market as one of the reasons why the Fed might stay on hold longer. And so this sort of just reinforces his message. The only real thing he said about the labor market is if the labor market collapses, then we would consider cutting right away. But that doesn't appear to be likely at this point.
Mike McKee breaking down the economic data, yields creeping just a little bit higher, again at the long end of the curve, and the front end as well, by 2 basis points, back through 470 on a 2-year. Work your way further out along the curve, a 10-year maturity just short of 440 at the moment. Yields higher by 3 or 4 basis points there. Clean break of 450 yesterday on a 30-year, again today by about 3 or 4 basis points. Steve Weiniger Citi still alongside us. Steve, let's talk about the jobs data we just got, the ADP report, and the data we got earlier this week, ISM manufacturing as well. Steve, Lisa's bringing up the right question, I think. Data dependency. What data should we be dependent on and shouldn't be? Steve, how much weight would you put on manufacturing earlier this week?
Well, look, I think it's been, useful data. We've been looking at a manufacturing sector that's been going through a correction, that's been depressed relative to demand. It's been, in fact, in a recession for the last year and a half, a mild one, but around the world. Now, that's not terribly relevant to the U.S. It's quite relevant to Germany. It's quite relevant to China. Now, there are other things that are going on in those places as well, but coming out of that, again, is, very hopeful for the longevity of the expansion. Now, again, what happens in services and what's going to happen in employment is really going to matter for us. It's going to matter for monetary policy, which is relevant for the world on the U.S. side. We did 184,000 jobs every month this year. That would just be wonderful. We'd probably get a 2 rate cut year, but that would be, great news. And it would be on the way to being a sustainable labor market. It's a lot closer than where it has been in the last couple of years.
So, Steve, it sounds like you do take some real signal from the non-farm payrolls report that we're going to get on Friday. Which aspect is it? Is it the headline number, as you mentioned, or are you looking at wages to see how much that stickiness really is present?
Well, it's all of these things. It's getting an impression from the sample-based data that you talked about. And it's putting it together over multiple months. The revisions are sometimes, as relevant for how we look at the data compared to just the headline numbers, whether they beat the consensus. Oh, well, fold in the revisions. The compensation data is interesting, but we have to take a look. Are there any big mix shifts? Are we going, are we doing it on the strength of retail hiring, or are we doing it, on IT services? You'll see different compensation numbers there. I'd say that the employment cost index, again, sort of a same-store sales measure of employment pressures, has come down, even without a collapse in the labor market. With a very, very minuscule rise in the unemployment rate, we've seen, compensation pressures moderate. And, I think if we could stay on that track and have monetary policy just moderate, again, come off of a very, very tight level that the yield curve is telling us, then we will be in a great place for making this a long expansion.
That's what's really going to help financial markets and the public at large.
Steve, constructive. It's great to hear from you. Steve Whiting there of Citi on this equity market. If you are just joining us, allow us to set the stage for you just quickly. The economic data came out just moments ago, about 10 minutes ago, the ADP report. Big upside surprise there, 184,000. The estimate was 150. This is going into payrolls Friday. The median estimate in our survey at the moment, and as we've said repeatedly all through the week and over the last few years as well, it's a moving target. You'll get more estimates going into Friday, but that's been going higher over the last few days, from about 200K to start the week to about 214 now, the previous number 275. It's actually shaping up to be a really interesting session again. If you just get to the commodity market and take a look at what's happening with crude, Brent crude getting closer and closer to 90. It's up by about 9/10 on the session, 89.70. That move in crude, in comparison, may be in a relationship at the moment with what's developing in the bond market. Yields higher again by 4 or 5 basis points, Lisa. The 10-year getting closer and closer to 440, just as crude gets closer and closer to 90.
And the 2-year now at almost 472, really climbing higher as we look at this. Is it the data, or is it just the mush that people are putting together, then sort of add in some sentiment and some questions around what the thesis is? To me, honestly, that's the question. Are people trading on ADP, or is it something else?
It's ADP for 5 minutes, isn't it? And they sort of get over it, and then it's something else. I'd say, can I say all the above?
Yeah, please.
All of the above. Coming up next on this program, former House Majority Leader Eric Cantor on the US deficit and a whole lot more. It's shaping up to be a very interesting Q2, just 3 days into the quarter. From New York City, you're watching Bloomberg Surveillance.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
"60 minutes away from the opening bell, equity futures pulling back just a touch by 0.2% on the S&P 500. We had the ADP jobs report out just moments ago. Came in at a punchy 184. Got no idea what that's worth for Friday. Upside surprise, the estimate 150. Friday payrolls, the estimate 214. So equities pulling back just a touch. Yields breaking out again. Let's switch up the board and get to the bond market. The 10-year high by close to 5 basis points, getting closer and closer to 440. We've only had 3 days of Q2. We ended Q1 at 420. So we're talking about close to a 20 basis point move, at least in just 3 sessions.
And it comes as all of the data, and you can challenge each point, but they're all kind of coming to the conclusion that this economy is robust. Mike McKee, before he left, pointed to one data point in the ADP report about job changers actually seeing their wages increase by more than 7%. That, I think, is giving people pause. There is a stickiness and a sort of demand for workers that is persistent in an economy that is not slowing as much as people expected.
The commodity market appears to be at the epicenter of a lot of what we're seeing develop over the last few days. So let's turn to crude. Getting closer and closer to 90, 89.71, positive by 0.9%. Anne-Marie, we heard from OPEC Plus a little bit earlier this morning, and they seem pretty happy with how things are developing.
Yep, steady as it goes. They're going to continue to ratchet back that supply, not adding any more. They're also going to go after the cheaters and try to get them in line to make sure they are hitting the correct quotas. Yesterday was really about geopolitical risk. Today was about supply when it comes to the oil market, and you heard that from Ed Morse, similar to what we heard yesterday from Amrita Sen.
Crude up, bond yields higher. We need to talk about the deficit in America. Citadel's Ken Griffin joining a chorus of CEOs expressing concern about the growing U.S. deficit, writing in a letter to investors, quote, "We must stop borrowing at the expense of future generations." His comments coming on the heels of BlackRock CEO Larry Fink warning, quote, "The situation is more urgent than I can ever remember. There's a bad scenario where the American economy starts looking like Japan's in the late 90s and early 2000s. In its latest projections, the CBO warning U.S. government debt is on a path from 97% of GDP last year to 116% by 24, higher even than in World War II. Eric Cantor joins us now, the former House Majority Leader and Vice Chair of Moelis & Company. Eric, good to see you, sir.
Good to be here.
We're all trying to figure out how close are we to a point where a leader in America comes out with a set of policies and this market rejects it. How close are we to that moment?
You know, John, it is so reminiscent of the discussion that we had even when I was on the Hill. And if you look back even 10 years ago, we were screaming the same thing, that we have reached a point of unsustainable debt levels. We have to do something about it. And I certainly agree with what both Ken Griffin and Larry Fink have said, that we are on an unsustainable path. I think, though, that the discussion around the debt and deficit is a little bit too simplistic because, yes, it's okay to have some level of debt and deficit. I think most people in their lives have it, and I think the government's the same. I think the trouble you get into is when you start growing that deficit and the debt more quickly than you grow the economy. And there is no agreement, though, on what to do about this. And so if the parties would sort of step back and focus on growing the economy, the decisions to correct the situation would be a little bit easier, the political cost a little less, if people could just try and focus on how we're growing the economy instead of a lot of the policy that's underway in Washington.
Isn't that the argument that the former administration led by President Donald Trump essentially made? That we can pile on more debt, but ultimately we're going to do it because we're pro-growth. Did that work out well?
No, because you've got to address both. I mean, there's no question that it is the demographics in our country and the healthcare costs and the increase in those healthcare costs turbocharged now with higher interest rates. That's where this trifecta of a really toxic mix that we've got that is threatening, I think, the future. And I don't know if we're going to see the two candidates for president, the incumbent, and Donald Trump, ever propose a fix to this. But I think we know how to do it. We talked about how to do it when I was there.
It's interesting that you have both sides of this. You have from the policy perspective when you were in Congress, and you have now from the Wall Street perspective when you're deciding how to invest and where to allocate. How convinced are you that this time is different, that the bond market is going to wake up to the risks that you see from the fiscal side?
Well, listen, I think on the deal-making side at Moelis, I mean, what we're seeing is clients who really reacted over the last couple of years to this volatility and uncertainty around interest rates. Obviously, interest rates, when you're in the deal-making business, are very, very impactful. So, I do think, at some point, the market is going to reject this continued incurrence of debt. I mean, we're spending $1.7 trillion more of money than we have every single year at some point. But again, I always go back to the fact that we're, quote unquote, the fastest kid on the block in this country. Where else are you going to put your money? And whether we're seeing signs of that now in diversification, I'm not sure yet. I'm not sure, because when I look at it and you look at the, ADP report out today, we'll get the jobs report out later this week. But, where else is there this innovation and dynamism? I mean, we're on a roll in this country where you've got more small business startups than we've ever had before. That is a signal that people are optimistic about America.
If the market, though, was to push Washington's hand, because Washington is not going to be the ones to come up with a plan for the fiscal deficit, are the right people in place? You had a great relationship in 2011 with then former Vice President Biden. He's spoken glowingly about you, able to work in a bipartisan fashion. Are the right people in place to actually come to the crisis?
Look, I think that the situation will demand that people, step up and come up with a solution. And there's really, to me, if you want to fix the problem and send the signal to the markets that the country and the investors in the markets that the country is on the right path, it's a simple notion, but it's difficult politically. You just take the steps to change the healthcare entitlement, the Medicare program, from a defined benefit system to a defined contribution, and basically offlay some of the risk to the beneficiaries. That's really, really tough politically. But if there were a crisis, if the markets did reject what's going on in Washington, you could take more interim steps to go in and tweak the age of retirement, to reduce the indexing of benefits. You could means test. There are some things where you could buy, and the government could buy us decade plus in terms of the viability of these programs.
That just doesn't win elections. I want to talk about some of the proposals we are hearing from the candidates. Former President Donald Trump is talking about 10% tariffs, a wall, and then 60% blanket tariffs on China. We ran the numbers, and that says PCE would be north of 3% yet again. Yeah. Do you think he would actually do that, given the fact that this can mean such higher inflation, especially on everyday Americans?
Well, I think it goes back to that admonition that someone had given back in 16, don't take him literally, take him figuratively. Who knows? Who knows what we can expect? I think the unpredictability is what he likes. And there's no question that his message is we have been taken advantage of by others, in particular China, and we need to step up and gain some leverage when we try and negotiate some resolution of this situation. But listen, there are very troubling signs coming out of China, separate and apart from the national security concerns around particularly sensitive industries. Because you think about what's going on with EVs and the fact that the Chinese government is well aware they've got to do something to take care of their domestic economy. So they are ramping up production in their manufacturing sector. And guess what? They're going to have so much excess that now they're already looking like they're sort of dumping all those into Europe. And the EV situation, very, very concerning. And our OEMs here are equally, I think, as concerned that that may happen.
When it comes to a deal-making perspective, how much are you avoiding cross-border deals because of some of these questions and concerns?
Well, I think it's very interesting because so much of the sectors that investors will look to, really, we're shining in the U.S., and there's a lot of European, Asian, Middle East investors who are looking to allocate their capital here in the U.S. But of course, there are political ramifications to monies coming in, and we've seen that when it comes to countries that are not aligned with us, whether it's China or someone else who is just not on the favored list. You have to go through the hoops with CFIUS and things like that. But I think the real concern that, I continue to hear from clients at Moelis and others is the fact that we've got a situation with our antitrust regulators that it's not just applicable to cross-border deals, it's applicable to every deal. And I think what Lena Khan, Jonathan Kanter have done at both FTC and DOJ has been such a stretch in terms of interpreting the law and the antitrust law. And they've, I think, done a disservice to our country, to investors, and frankly, damaging the competitiveness of America as a destination for capital.
That's the world we live in right now. We were talking to Brian Moynihan just the other week on the trading floor of Bank of America. Had a similar complaint. He was talking about the amount of deals that were being held back by the prospect of them just not being able to pass, not being able to go through. And no one wanted to be on the wrong side of that, being left to hang out to dry for a year without any idea of whether the deal will close or not. Are you seeing the same thing? Potential deals that could close that just aren't being made right now?
You know, I do think, and what I will say to decision makers is that, you know, if we're going to go forward, if there's going to be a deal to work, we're going to have to make sure that we allocate the necessary time, resources, and commitment to get through that process. But think about it. If we like to be the location in the world where capital flows to its most efficient use, where it's the most dynamic economy, velocity of capital, we shouldn't have to do this. And unfortunately, there is just an overwhelming ideology that's infecting the policy in the current administration in Washington that is not necessarily that favorable. But again, all the while you look to and say, where else? Or is it any better?
Let me ask you this, though. Is that ideology infecting both parties? Because right on cue, deal crosses the Bloomberg terminal, we announce it, we talk about it, we go to the Twitter account of the Senator of Massachusetts, tweet, shock. Not surprised at all. What is surprising is the amount of Republicans that agree with it now. That's a shift. And I'm trying to work out, do we actually have a business-friendly party in Washington anymore? Does one exist?
Well, listen, I always like to say I'm a limited government, pro-free market, pro-national security, conservative Republican. But I agree, Jonathan, with your sentiment that Donald Trump has changed the nature of the Republican Party. We are, I believe now, perceived as the working class party, and the Democratic Party has done more to ingratiate itself with "quote unquote" the elite and the very far left on the ideological spectrum, and somehow the extremes are meeting, and you're seeing this happen. And I worry about this because this extreme push in terms of government role in the economy has happened with the support of both parties. You look at the IRA bill, certainly that was one party, that was the Democratic Party, but if you look at the CHIPS bill, look what that did. I mean, that was industrial policy focused on a particular industry that folks in my party decided was a good thing for national security, so let's let the government go all in. That is not sort of the limited government outlook that you see. And so you're right, there is a shift towards labor. Labor is in the polling, public polling in this country at an all-time high in terms of favorability. And both parties, you've seen it. How in the world can a White House go and join the picket lines? That's what President Biden did. But you know what? So did Donald Trump. So did several Republican senators join the picket lines in Detroit.
Well, to Jonathan's point, J.D. Vance, who is a VP shortlist candidate, literally came out and said he thinks Lena Khan is maybe the only effective person in the Biden administration. So say it was to be Trump, are you getting the same sort of DOJ, same sort of FTC?
You know, that's the real question as to whether we're going to continue to see the extremity. I don't buy that because I still think there is a DNA.
You're a product of that extremity. You lost your seat because of that, and that populist wave that people said you were really the beginning of it.
But remember where the anger was. The anger really was against the so-called establishment. It wasn't necessarily towards, you know, it was towards everything. We thought and probably assigned an weight to the import of profligate spending in Washington. I think it was just more, it is about the establishment, the system, etc. I don't necessarily think people are going to the polls in November based on antitrust regulation. I really don't. So I think that where you're going to have manifest in a next Republican Trump administration is more of the DNA that's a little bit more balanced and not so punitive on corporates.
People might not be going to the polls, but you have to plan a business around it. And that's really one of the key questions. And we keep getting people in here saying, Lori Calvasina, it's like staring at the sun. How do you plan for something that feels like it is shifting and you don't know exactly how? Is there any way that you are planning with the business and the deal making to get ahead of whatever kind of push we're going to get in November?
So I just think that we've got to be very mindful. In 2025, there will be the Super Bowl of fiscal policy debate, because you've got expiration of the Trump tax cuts, and some would say, well, not all of them. Well, yes, there will be. Everything will be on the table. And just to extend the lower, the $400,000 and under income bracket, that's a $3.2 trillion issue. You talk about the debt, fiscal year 23, we were at $791 billion of interest cost, and we're going up. And so everything's going to be on the table. IRA, the subsidies. I would say, if there's any anticipation and advice I would give for those who have been on the uptake in terms of these subsidies with the IRA, especially as it relates to EVs and the renewable industries, we better take a real look to see whether we think those will continue, because they're going to be on the table too. I believe my party will first up look at some of those subsidies and get rid of them.
So final question for you, trying to work this all out, because I think this is really, really difficult. In 2016, we had a candidate, and I think if you could divorce the person from the policy you looked at was pro-business, low taxes, confrontation at some point with China. And then TikTok happened in the last couple of weeks, and I was just thinking, is the Trump template from Volume 1 applicable to Volume 2? Do you think it is?
I do. I don't think that he has changed much in terms of his career trajectory. He's always been anti-China. He's always tried to go and gain some leverage in negotiations. He's a deal maker. I also think that he is focused on a growing economy. I think at the end of the day, with all the noise you see from J.D. Vance coming together with Elizabeth Warren and what have you, at the end of the day, the Trump administration next time will be pro-business, because he'll want to see a growing economy.
I could talk to you all day. This was great. Let's do it again soon.
Terrific.
Eric, thank you. Eric Cantor there of Moelis. Let's get you an update on stories elsewhere, just briefly, with your Bloomberg brief. Here is Yahara Hakez. Hey, Yahara.
Hi, John. Endeavor Group, the controlling investor in WWE and the Ultimate Fighting Championship, has agreed to be acquired by private equity firm Silver Lake. The $13 billion buyout follows through on plans announced back in October. Endeavor said at the time it was evaluating strategic options out of frustration with the company's declining stock price. Disney holds its annual shareholder meeting today, and Bloomberg can now report the company is poised to win enough shareholder votes to defeat a challenge against its board mounted by activist investor Nelson Peltz. Elon Musk weighing in, saying that while he doesn't own any Disney shares today, he would definitely buy if Peltz was elected to the company's board. President Biden and former President Trump both added to their delegate counts last night. 4 more states held primaries on Tuesday, and the presumptive nominees easily won in New York, Connecticut, Rhode Island, and Wisconsin. Trump picked up 78 to 84% of the Republican votes, while Biden took 83 to 91.5% on the Democratic side. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, a wake-up call for chip makers.
What's very interesting here is that it's another big wake-up call for us, which is like we all rely on farms that are selling in Taiwan, and the situation could have been much, much worse, and we could have lost production capacity.
That conversation up next, live from New York City. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Counting it down to the opening bell, about 41 minutes away. Equity futures negative by 0.2%. Yields creeping higher by 4 basis points, closer to 440, closer to 90 on Brent crude today. Brent crude at the moment higher by about 0.75%, 89.60. Under surveillance this morning, it's a wake-up call for chip makers.
What's very interesting here is that it's another big wake-up call for us, which is like we all rely on farms that are selling in Taiwan. And the situation could have been much, much worse, and we could have lost production capacity. And if we are losing production capacity, we would be back into an after-COVID kind of situation where the whole economy is, struggling to find chips.
Here's the latest this morning. Hundreds are injured and at least 9 are dead after Taiwan's strongest earthquake in 25 years. Flagship chip maker Taiwan Semiconductor is moving some staff out of facilities and is assessing the impact and the potential for aftershocks. Taiwan is the source of approximately 80 to 90% of the world's highest-end chips. Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence, joins us now for more. Mandeep, Taiwan Semi is down about 1.6%. I think we're all trying to figure out here at Bloomberg just what damage has been done. What damage has been done so far?
I mean, obviously, it's a tragic event, and clearly we don't know the extent of the shutdowns or if there have been any, leakages, gases. There's a lot that goes into, manufacturing semis, and it's a pretty complicated setup. So we don't know the extent of, the damage, but what we know is clearly there's been some loss of lives. And I think when it comes to factories, I would imagine there is a temporary shutdown, and we'll find out exactly how much impact it will have on the production.
We have to wait for exactly how much it has been, but what could the impact be? What would that materially mean?
Well, so think of, some of these manufacturing nodes are like 3-5 nanometer. That requires a lot of, talented people to show up at these factories, as well as in terms of the setup. We're talking about really, complicated things in terms of how, as I said, there's a lot of gases that goes into manufacturing these semiconductors. And I think clearly there will be a level of disruption, but the leading nodes is where all the focus is, because that's what all these companies rely on. At the end of the day, they are the primary factory for manufacturing the leading node chips.
The parallel here of what's going on with the possible disruption at Taiwan Semiconductor Manufacturing Company, and then Intel reporting widening losses at their foundry, just highlights how difficult it is, the barrier to entry, to really diversify some of the output of these chips. Can you give us a sense of why it has been so difficult to move production to places like Japan, like the US, to try to insulate from potential supply shocks?
Yeah, I mean, look, I think Intel said they will lose about $7 billion in foundry operations. So that just goes to show that, they are investing a lot of CapEx upfront to bring the leading node manufacturing in the US. But what it requires is not only the setup with the EUV machines, but also the components and all the parts that goes into manufacturing semis and the talent. I mean, one of the reasons why it's been so hard to relocate the supply chains out of Taiwan is because you don't have the availability of talent elsewhere. And that, I think, is Intel's challenge as well, because they also go to TSMC to manufacture their latest 2 nanometer, 3 nanometer chips. So that just tells you that despite investing so much, they're still relying on TSMC.
Mandeep, you could write a book on this. Books have been written about this. If you had a map of the world and you wanted to pick the worst places to build these things, that's where they are. We'll get into another day why they're there. Just how long does it take to build replacements for them? And not just to build the physical plant, but to attract the talent as well.
Well, so I think it requires a lot of training. Some of what Intel is pitching to all the governments is, look, we are not only setting up fabs, we are training people. And that training would require, a few months, years for that matter, just to, train people in terms of how to use this equipment. So clearly, I think TSMC and Samsung, the other fab makers, are also opening up these plants. And they have plans to, do manufacturing in the US, but they will run into the same sort of issues. At the end of the day, you need to train people, and that requires time. There is no CapEx, kind of immediate CapEx that you can use to train people.
Is there effectively then no substitute?
Well, as of now, I think if you're looking 12 months out, there is none. And if something were to happen in this case with the earthquake, clearly things will come to a standstill in terms of leading node manufacturing. I think 3 years from now, 5 years from now, Intel gave a 2030 forecast where they expect Intel Foundry gross margins to be 40%. Now, that's a dream scenario. Right now, they're bleeding money. It's negative gross margins. So that just goes to show there's a lot of hope in terms of what can be accomplished. But I think a lot needs to be executed upon.
Mandeep, thank you, sir. A difficult moment in Taiwan. Mandeep Singh there of Bloomberg Intelligence. Coming up tomorrow, this is what the lineup looks like. John Stolfus of Oppenheimer Asset Management, very bullish. We'll catch up with the Israeli Economy Minister as well. Jean Bavan of BlackRock and Becky Frankiewicz of Manpower Group on a big week for labour market data. Earlier on this hour, we had the ADP jobs report. That came in, Bramo, at 184, the estimate, 150.
And the highlight, and Michael McKee pointed to this before he left, but the fact that job changer wages surged 10% in that survey has the attention of many people in the market, including Ian Lingen of BMO Capital Markets, saying maybe this suggests more heat under the surface than people had previously expected.
The next stop for this market, 10 a.m. Eastern Time, the ISM services read. Q2 starting with a bit of a bang after what we saw with the ISM manufacturing read on Monday. Then it's on to Chairman Powell later on this afternoon. Tomorrow, it's on to jobless claims, and then it's on to payrolls Friday. Your equity market going into the opening bell shaping up as follows. About 34 minutes away from the cash open, with equity futures on the S&P slightly negative. We're down 0.2%, and bond yields higher by 5 basis points. Your 10-year 4.3952, and crude 86, very, very close. Inside $90 on Brent from New York City. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Let me ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. So we've got a drawdown on equities. Again, tech under pressure. Goldman Sachs Prime Brokerage sees some pretty heavy shorting, the most in 6 months. We'll dig deeper. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up in the show, surging bond yields spoil the equity rally. Chairman Powell leading another busy day for Fed speak. And Taiwan suffers its largest earthquake in almost 25 years. We begin with the big issue. Q2 kicks off, bringing out the burrs.
What people have kind of shifted to is that without this high conviction view on where rates are going, we're in this kind of hold period now. You know, you had the big hiking cycle. Now we're just waiting for the cutting cycle. I think people have kind of moved away from those high conviction directional views. They're looking for spots to add carry or to find ways to kind of eke out some returns without taking those big views. So I think people are actually fairly neutral on duration, on the direction of rates right here.
RBA are neutral. My guests this morning are Zach Griffiths of Credit Insights and Leslie Falcone of UBS. Good to have you both with me. We're now up 19 basis points. In the space of 3 days, I put it to you that the burrs have been brought out of hibernation, but the vigilantes are at bay. What do you say to that, Zach Griffiths?
It does seem like the bears are out to play this week, and we're a little bit surprised by the size of the move on what seems to be one ISM manufacturing print that showed a return to expansion territory and a little bit of an uptick in prices paid. We think that's probably being a little bit overweighted in terms of how much the market has reacted this week. Obviously, we have non-farm payrolls at the end of this week and then CPI next week. I think the story is still a little bit more balanced, especially if, as we expect, the consumer slows down this year. I don't think an uptick in manufacturing outweighs that.
Leslie, good morning to you. I've had various people say to me, it's an overreaction, it's a pop. You just want to remain stoic and maybe even add to duration on the pop in yield. Good morning. What's your take? Overreaction? Buyer of duration here?
You know, good morning. Listen, we've had the market reprice and the narrative shift. You know, within 2.5 months, we've had the market remove about 80 basis points of cuts in 2024. It was always our expectation that the Fed wouldn't cut until, mid-year. I think the market's reaction right now is a bit of a repricing of after being a little bit overzealous. But regardless, how data dependent the market is on that is right now, that doesn't alter the long-term trend in our view, which is that interest rates are going lower.
Okay, well, we've had a little bit of Fed speak so far. San Francisco Fed President Mary Daly reiterating her forecast of 3 rate cuts for 2024.
Baseline, but I would like to say here that this is a projection, right? 3 rate cuts is a projection, and a projection is not a promise.
Beautiful line. Projection is not a promise. Remember that. Mike McKee, good day to you. 2 voters, Messer and Daly yesterday, again reaffirming the commitment to 3. Today it's Powell's turn. Where do we go?
Well, we probably go more in the same direction that we have been going. I mean, it's obvious that markets never overreact to what they think the Fed might be doing. Take a look at what they're reacting to this morning. That's ADP. ADP, which measures private sector jobs, comes in at 184,000. The survey says it's going to be 170,000. So ADP more optimistic. But as you can see, their lines don't match up with the Bureau of Labor Statistic lines. So they say it's not a forecast. Make of it what you will. The yellow line is interesting, though, because that's the average pay gain on an annual basis for people who switch jobs, and look at that rocket up in the past 2 months. Is that inflationary? Is that going to worry the Fed? There's a question for you. Today, we do get ISM services to add to that ISM manufacturing number. We'll see how many employees we see in the services industry. Do they report that things are getting better? Austin Goolsbee and Anita Kugler speak today on the economy. We'll see whether they add their voices to the wait camp. Tomorrow, jobless claims, and 3 more members of the Open Market Committee, Harker, Barkin, and Kashkari, speaking on the economy. Friday, the big day, jobs report, 214,000 is the forecast now. It was 200,000 2 days ago. So we have seen a rise based on the data that we are getting, 3.8%, a tick down for unemployment. We'll see again if that changes before Friday. What will Powell say? Well, he's probably going to echo what his colleagues are saying. Loretta Mester, along with Mary Daly, saying yesterday the bigger risk would be to begin reducing the funds rate too early, but with labor markets and economic growth being very solid, we do not need to take that risk. And as you heard Mary Daly saying, same thing, growth is strong, no reason to adjust the rate. And the markets are buying into that at this point. I just point this out, this little number's out for you here, Manus, because we had seen a full rate cut priced in for July. First it was June, then it was July, and now we are below a full rate cut priced in for July. You have to go to September to get that in. That's a long way away. Markets starting to listen to the Fed and buy into what they're saying.
Yeah, it's getting sweaty for some of the people there in the rates markets. Mike, thank you very much. Great laying of the table. My guests this morning, Zach and Leslie, are back with me. So, Zach, I want to go to you. You're still all in there on 100 basis points of a cut for this year. You think growth and disinflation will both continue. Growth will slow, disinflation will continue. Getting a little bit sweaty, ADP. The wages numbers, 10%. If I shift my job, 184,000. We're looking for a bullish jobs report. Is it a little bit, are you feeling a little bit less comfortable with the call?
Well, I'd say the latest data really over the past week are making us reconsider what we're going to see on the good side. That's been something that we've been expecting to be a continued driver of disinflation this year. I think the other thing that we're really seeing out there that's not being highlighted with the recent data is more value-seeking behavior by consumers, pointing to rate hikes finally squeezing the consumer as we see some of the fiscal stimulus that we had really work its way through the system. And so I think that we'll be looking to see average hourly earnings on Friday to see if there are wage pressures still contributing to the overall inflation picture, but we are comfortable with inflation coming down this year and the Fed able to deliver cuts to really just dial back the level of restriction in terms of policy, not take it to accommodative territory anytime soon.
Just before I put Leslie back into the conversation, I want you both to consider this, is can they pull the trigger on rate cuts with PCE at 2.8%, or do they need to see this closer to 2.5%? A fill or kill answer from you, Zach, before I bring Leslie back in.
They don't need to see it closer. I think they can start moving soon.
Okay, Leslie, you obviously have an observation that we are going to have a continuation. Growth is going to moderate, I think is the language that you use, from the unsustainable levels that you saw at the back end of 2023, which again builds on this disinflation narrative. We're going to get rate cuts because it's restrictive and because of the disinflation rather than a perilous growth story.
Yeah, I mean, listen, as Zach had mentioned, we think that this rate cuts this year, and frankly, whether it's June or July, whether it's 75 or 50, cuts doesn't really alter our view. I mean, we view this year's rate cuts as more of a maintenance cuts. I mean, cutting 70, 50 or 75 still keeps the Fed fund rates very restrictive. It just really protects against if, in fact, the labor market should start to, weaken quickly in order to make sure that growth doesn't fall too much. So we view this as more of a maintenance cut. So we don't think that inflation, while sticky, and we do believe in the higher for longer, is going to be that big of a concern. What we do look at in terms of our long-term interest rate outlook is where that neutral rate is, where the market is pricing that neutral rate. And right now it's at 3.8. That's very high. So I think that there is room for the market to rally. And unless we go back to those pre-GFC levels of a neutral rate of 4.5%, regardless if they cut or June or July or 75 or 50, in the long term, interest rates are going to go down.
Okay, let's translate some of this into the broader market perspective. I'm drawn to what you both talk about in terms of high yield. Leslie, you make it very clear that there's been a lot of refinancing, a lot of the hard work at the financing cliff has been done. And so that changes your view to perhaps a little bit more neutral there. Zach, you just take the hatchet out. You downgrading your recommendations on IG and high yield to market weight. And I take it from both of you. Zach, let's start with you. This is about the already compressed spreads that we've seen.
That's right, Manus. And when we just think about how to position a portfolio right now, we don't think there's a ton of juice left to squeeze in terms of the spread tightening trade, but we do think it's an attractive carry environment, and we think spreads can remain fairly stable for the next several months until perhaps we get a little bit more volatility in the market driven by the election, maybe thinner markets during summer causing spreads to widen a bit from where we are. So we think the risks of the outlook are a little bit more balanced than when we put out our overweight recommendations in early December.
And Leslie, for you, again, I'm hearing more and more of this narrative, which is about coupon clipping. It's about take your coupons, not be grateful for them, but that's the practice rather than spread compression.
Yeah, I mean, we're not expecting that much spread compression, you know, in high yield or investment grade corporates for that matter. I mean, you know, risk premiums are tight, but we do think that spreads will be range bound. And any sort of correction that we see in high yield spreads, we view as opportunistic. And it actually, I think, would welcome investors. There's a lot of money sitting on the sidelines. Private credit is alive and well, which is keeping high yield spreads tighter also. But we don't think from a relative value perspective, the high yield market is fundamentally cheap. So we do keep that neutral rating because we're not willing to short that carry. You know, obviously it depends on, you know, going forward, given the fact that we think growth slows but stays above trend, and we don't think inflation skyrockets, is really going to be important for the high yield market. And obviously it's had such a large correlation to equities. We've seen a really big outperformance in the first quarter, even though rates have risen. So we do anticipate a little bit of spread widening, but not enough for us to short that 8% carry.
Okay, stick with me. We've got a little bit more to do. Zach Griffiths, Leslie Falconio, my guest this morning. Let's look under the hood at these stocks moving ahead of the opening bell. Abigail Doolittle is with me. Abby.
Well, Manus, right now we are looking at the possibility of a third down day in a row for the S&P 500, really dragging one stock in particular, Intel, down more than 5%. They provided an update that shows losses at some of its U.S. factories last year widened, and that a turnaround really still needs to be proven. In addition, of course, on that worst Taiwan quake in 25 years, that tragedy chipped overall under pressure. TSMC directly impacted, but there are fears that there could be ripples out of that earthquake and TSMC's closure there. And then Tesla down for a fourth day in a row, potentially, after a 7% three-day slide and reporting 386,000 deliveries for the first quarter there, roughly thereabout, which is a greater than 10% miss, the worst ever, according to Bloomberg tracking. This stock now, Manus, down 45% from last year's peak, down once again here in the pre-market. Tesla.
It is brutal on that. Is all the bad news in? Abby, thank you very much. We'll reflect on that a little bit later in the show. Coming up, the semiconductor sector figuring out the damage from Taiwan.
What's very interesting here is that it's another big wake-up call for us, which is like we all rely on farms that are sitting in Taiwan. And the situation could have been much, much worse, and we could have lost production capacity.
More on the world's largest contract chip maker, down 1.5% of the close in Taiwan on Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges. Britain's next.
Was going to keep rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
What's very interesting here is that it's another big wake-up call for us, which is like we all rely on farms that are selling in Taiwan, and the situation could have been much, much worse, and we could have lost production capacity. And if we are losing production capacity, we would be back into an after-COVID kind of situation where the whole economy is, struggling to find chips.
So there you go, a wake-up call. Taiwan recovering from its largest earthquake in 25 years. Officials say at least 9 people have lost their life and more than 900 are suffering injuries. This earthquake also impacting the global semiconductor industry. Taiwan Semiconductor is saying it has moved some staff out of its production centers for safety precautions. Its 2 biggest clients, I mean, there's Taiwan Semiconductors for you, Apple and NVIDIA, both low. I should just actually correct myself. I said a little bit earlier that it was Taiwan Semiconductor at the close. That was the AD, or the American Depository Receipt I was showing you, not the close in Taiwan, which was down 1.25%. So we're accelerating, a small amount, but we are accelerating past the losses on the Taiwan exchange. My reporter on this is, not reporter, our Bloomberg intelligence specialist is Mandeep Singh with me. Mandeep, we're grappling with the human side of this earthquake, but from the production side, just how nuanced is the production of chips? What are we missing here? Taiwan Semiconductors is a benchmark for us when we're talking about the chip industry. They're moving staff out of factories. What does that say to you about the scale of interruption, potentially?
Yeah, look, I think when it comes to running these high-end fabs, you're talking about different components that go into it, whether it's your power, water, special types of gases, and ultimately it's the people. I mean, it is pretty manually intensive in terms of having high-end talent kind of operate these, $200+ million tools. So clearly, there is a lot that goes into, making this special factory run seamlessly. And a disruption like this, a tragic event like this, I think does set them back. But we don't know exactly how far it is from, the setup they have, TSMC has in Taiwan. So it'll be interesting to learn about the details. And to my knowledge, right now, it's supposed to be a temporary disruption.
It really throws a light on the strategic importance, of Taiwan geographically, politically, and from a production point of view. And they're trying to diversify their locations away from Taiwan into the UK and other countries. Stock's down 5.4% at the moment. There's also a huge disruption in the news flow with Intel. I mean, they were the biggest beneficiaries of some subsidies here in the United States of America recently, but we understand that their attempt to grow that chip-making business, it's hitting some pretty big financial headwinds.
Yeah, look, I think when it comes to the foundry side, what we have learned is they're losing almost $7 billion every year, and the gross margin is negative for that business. Now, you have to remember with Intel Foundry, 1/3 of the capacity is used for their own chips. Intel is an IDM, so it doesn't just make chips for outside companies or fabless companies, but also its own chips, whether it's the CPUs, and it's trying to get into the GPU space as well. And look, until they find ways to run this on a profitable basis, it's hard to justify all these investments they are making at the foundry level. So still a lot of details have to surface in terms of the unit economics of Intel's fabs, but clearly they need this to catch up to TSMC and also, have a lower cost chip compared to their rivals NVIDIA and AMD when it comes to the GPU side of things.
Okay, Mandeep, thank you very much. Two big movers in the chip space today. Let's pivot to oil and the markets there. We've got OPEC Plus sticking with their cuts for the first half of 2024. The members once again urged to adhere to their commitments. I caught up with Bob McNally of Rapid Energy a little bit earlier.
We've modeled an interruption in the flow from the Strait of Hormuz, and it's also the oil produced in, like Abcake. It's onshore production facilities and the choke point. All that's a $40. If that gets interrupted, that's a $40 rise in oil prices. Until we hit, it'll cause a recession.
Now, this is a risk to global markets and sentiment, isn't it, Zach, Leslie? Good to have you back with me, which is a geopolitical spike, oil supply interrupted. That's Bob McNally extrapolating what they think is a 30% possibility of a massive interruption. But for you within your world, this is about the disruptive element of a rising oil market in an already delicate inflationary world at the moment, Zach, where we're trying to get this disinflation narrative to continue. How irksome is the ratcheting of oil prices to you, or is it not hit a critical level just yet?
It's definitely a concern, Manus, and a move of that magnitude would have huge implications for inflation broadly. And so when we think about the key risks to our outlook, we do see the possibility that goods inflation broadly starts to rise after we've seen several months of deflation as a key risk. And I think if you look at market pricing for break-even inflation expectations, they've started to rise across the curve. So we don't think that the inflation forecast is without risk, but we see bigger drivers pointing toward more disinflation ahead, absent a huge supply shock to the oil market.
Leslie, you have already, one could say you're prescient and ahead of the pack. You already had a long tips position. Part of that was predicated on the energy market. How irksome is this move? I mean, Bob was giving us a scenario analysis, which I was surprised to see. There's only $1 of geopolitical premium in the price at the moment. What he's laying in front of me is a 30% probability of major disruption and a $40 pop.
Yeah, I mean, listen, we're still in the ranges that we've seen before, right? So I think it really depends on the sustainability, of where these commodity prices are going. I mean, but we expect, some of these supply issues to sort of elevate in June. But it depends on how sustainable it is, and it depends on whether or not we break out from a range that we've already seen. I mean, part of our, investment in the inflation protection has been because, when we had real yields at 2.5%, you really start to compete against risk assets. And we looked at, some of these forward inflation swaps that were much higher than what the current break-evens were pricing in. Now we're getting a bit of a catch-up on the break-even side, and we think that continues.
And let's just round it off in terms of the biggest risk out there. I was listening to Mr. Cantor on surveillance just a short time ago. He said, next year we face the Super Bowl of fiscal policy debate. So fiscal policy, Zach, could be a very explosive time bomb for us. Nobody wants to deal with the fiscal dilemma in Washington, do they? It's just like a political suicide mission.
It's a difficult situation, and the election this year certainly highlights that. I do think that there is a lot of political risk here in the U.S. and geopolitical risk that markets are seemingly comfortable with now, but it wouldn't take a ton, in our view, to kind of disrupt the calm markets that we have. So that's certainly something that we are factoring in as a key risk when we look ahead to the second half of 2024.
Well, he certainly laid it out very clearly. There's an issue around tax, debt, the IRA, the subsidies in EVs. So it could get frisky in the fiscal elements next year, regardless of who is in the White House. Thank you so much to both of you this morning. That's Zach Griffith and Leslie Falconio, my guests on the markets. Coming up, your morning calls. Darryl Cronk will join me from Wells Fargo, telling us this: proceed with caution. Why he sees further downside to the equity markets. That conversation right ahead.
Trends in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
It just wasn't supposed to be that way at the start of the second quarter. Bonds and equities both down, ratcheting yields on the upside. The laggards in the NASDAQ, of course, are down to Tesla. Intel also dragging the narrative a little bit lower today. But tech is on the back foot. The question you need to ask yourself is on the drawdowns. And we haven't seen a drawdown in 2024 for quite a while of more than 2%. Are you getting closer to the point of where these mini dips, as Max Kettner told you on Monday, was an opportunity to step in? Roll it over, have a look at the bonds. 19 basis points in the space of 3 trading sessions so far. Again, up another 6 basis points this morning. We've just had the ADP numbers. Okay, doesn't run with the jobs report, you'll say. But if you change your job, you get a 10% pay rise. Not bad. Let's have a look at what the scribes of Wall Street have got for you. Redburn Atlantic upgrades UPS to a buy, expecting the shares to benefit from an improving macroeconomic landscape. JP Morgan downgrades Ally Financial to underweight, seeing limited upside after recent gains. And finally, Gordon Haskett downgrades Lowe's to hold, pointing to higher gasoline prices and mounting U.S. election risk. Coming up on the show, going to catch up with Wells Fargo's Darryl Cronk on why it is time to be more cautious in the equity markets, right here on Bloomberg. Good morning from New York.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Income Fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
Equities have had a little bit of a punch taken out of them in these first 3 days of April trading. On the NASDAQ, yes, Tesla is your worst performer there. In terms of points drawn off the S&P 500, it's actually Apple. It may be just a modicum lower this morning, but in terms of points taken off the S&P 500, it is Apple. Tech is definitely under pressure as we grapple with this mini drive-by in the rates market. There we go. We're going to roll over into the cash open. Let's see how we perform. This is the cross-asset sectors for you. We have got the euro-dollar up by 0.1%. And the yields rise again by 6 basis points. Now, this is a 3-day mini rout. Some people are saying to us on the show, look, this is an overreaction. This is an opportunity for you to add duration. But the short positions are mounting at JP Morgan on the client survey. They're seeing the highest short positions since January of this year. Crude is up as OPEC Plus confirms their cuts. Bob McNally this morning with me this morning. 30% possibility of escalation in the Strait of Hormuz. That would add $40 to the price of oil. We're up 0.5%. One stock to keep a track of through the day, it is Intel. Now, the chip maker, as we've been telling you, revealing factory losses have deepened and may not break even until 2030. Ed Ludlow, this was a truth and reconciliation moment, a diversification for Intel, wasn't it?
Yeah, Pat Gelsinger, the Intel CEO, has been pitching this turnaround plan, and this is the first time that he kind of unveiled the progress on that plan and when it will come to fruition. The stock's down 5.5%. It's trading at its lowest level since the first week of December. This is the second biggest drop within 2024 so far, or the biggest drop since the last week of January. We learn a lot about the foundry business, the contract manufacturing business where Intel manufactures semiconductors for third parties. Widening losses and dropping sales, as you said. So in 2022, sales were $27.5 billion. They fell to $18.9 billion in 2023. The operating loss widened from $5.2 billion in 2022 to $7 billion in 2023. Part of the story that Pat Gelsinger has been trying to tell is technology leadership in the manufacturing of chips. What I would do is tell our audience, go on the Bloomberg terminal, look at the margin guidance, and the historic high or peak margins for this company are north of 60%. The guidance for what's to come in the coming years and by the end of the decade isn't quite near that. They're talking about being operationally profitable at some point between now and 2030. So the sell siders see hope that the turnaround plan will come. It will come later than everyone thought, but there's still belief that separating out the foundry business from the design, essentially the products business, is the right move. And he's also installed a CFO for that standalone foundry business as well, whose name is Lorenzo Flores.
Ed, thank you very much for the update on Intel there. Let's pivot to Disney. The company is preparing to settle a boardroom showdown with its shareholder meeting today. Abigail Doolittle has the details. So this is about Nelson Peltz getting onto this board or not, as the case may be.
Well, that is the big question of whether or not that could happen. And the Wall Street Journal recently reporting that Disney may be winning that proxy battle right now. We won't know until the entire process is through. But this year, Manus, it's pretty amazing. Into this annual shareholder meeting that investors really look forward to, the stock up about 35%, really outperforming the S&P 500. Some of it may have to do with that proxy battle, but there are other things going on on there, including better than expected earnings. They also have a new strategy for both ESPN and Hulu, cost saving coming from job cuts. The stock is not only outperforming the S&P 500, but its streaming rival Netflix up 25% on the year. Again, Disney up about 35%. So CEO Bob Iger today, he will have a big test in terms of questions that he'll be fielding around that proxy battle. But also investors will be looking for clues on improved performance. Will it continue? Free cash flow in particular, park operating income growth, and streaming that's close to profitability. When will that happen? As for this year's big move and whether or not the stock is truly cheap, as some people have been saying, to buy it, if you look at the valuation per Bloomberg metrics over the last 5 years, it's right in the middle of the range. And also relative to that big rally, well, Disney had been down as much as 60% from its March 2021 high. Now it's up. Now it's down 39% from that level. When you put that next to the S&P 500 being up 33%, it seems as though maybe this is also a bit of a catch-up trade, Manus.
Okay, well, it's certainly going to come down to those institutional shareholders making the decisions. Vanguard, BlackRock, the likes of those. Abby, thank you so much. Let's turn to the food space. We've got Cal Maine jumping this after the egg producer showed strong sales due to big demand. Simone Foxman is with me. Simone, what have we got?
Oh, Manus, can we call them excellent returns? Perhaps. We saw consumer demand for eggs strong, especially during the winter holiday season. That is what the company said in a statement yesterday. And it said it had actually seen dozens of eggs sold, reaching a record at over 300 million. That's for the third quarter ending in early March. And this is flirting with the highest close since December 2022. We saw that playing out in the financials. Earnings per share coming in at $3 a share. And this despite net sales that were actually down on the whole on a numbers basis, about 30% year on year, and selling price down 32% year on year. But remember, back at that time in that third quarter of 2023 fiscal year, that was the outbreak of avian flu. Should be noted, however, Cal Maine is still dealing with outbreaks of avian flu, culling 3.6% of its flock. That's 1.6 million laying hens after birds at a Texas facility tested positive. That led to a brief drop in price yesterday, though it made most of that back. Stevens analysts warning that there is a prospect that this could impact production and tighten egg supply. Shares, though, reacting to the positive news on the record dozens of eggs sold, and shares up over 5% this morning. Manus.
Simone, thank you very much. I've just got to the part in billions where Axe Capital tries to corner the chicken market. There you go. Series 3. How do you pivot from chickens to EVs? We'll do it seamlessly. And let's talk about Tesla. The delivery miss, you know, we've been talking about it for 24 hours. It is hurting the car makers' market share in China. That's the world's biggest automotive market. Alex Semenova is with me now. So we are plunging on this stock again, down 0.7%. A lot of the hurt was in yesterday, Alex. What's the narrative that the market feels now? Are we somewhere near a bottom?
Good morning, Manus. The tough times do continue for Tesla. Local competition, weakening consumer demand. Those are some of the reasons that its market share in China fell in the final quarter of 2023, dropped below 7%. That's down from 10.5% at the start of last year. That's based on calculations from Bloomberg. And this dent in its standing in the world's second biggest economy and largest auto market also adds to a global slowdown in electric vehicle demand that has hurt Tesla. It just posted its biggest ever quarterly sales decline. Tesla has been having a particularly hard time in China with two models, specifically its Model 3 sedan and its Model Y sports utility vehicle. In contrast, some of its competitors have fared much better. BYD, NIO offering a wider range of different vehicles with technology options. Shares of Tesla are down again this morning after a nearly 5% drop yesterday. And this, of course, builds on a 33% drop year to date through yesterday's close. The stock is also nearing a key make or break technical level that a lot of traders are watching. And as you had mentioned earlier, it is now the worst performing stock in the NASDAQ 100 index and the second worst performer in the S&P 500 index, Manus.
Alex, thank you very much. Alex Semenova there. With stocks and bonds both under pressure as we await the remarks from the Fed Chair, Jay Powell. That is this afternoon. My next guest writes this: lighten up on the top 12-month outperformers, communication services, tech, and consumer discretionary sectors, and buy your favorite energy, materials, industrials, healthcare, and sectors. Darryl Cronk is my guest, CIO of Wealth Management, Wealth and Investment Management over at Wells Fargo. Do you accelerate the pivot, or are you just nudged along by the past 3 days? Darryl, good morning.
Good morning, Manny. Great to be with you. Yeah, look, I mean, I think you can still find value in the equity markets in those sectors. You look at energy setting new 12-month highs, industrial setting new 12-month highs, materials are showing strong signs of turning. And then you look at, you know, comm services up 50% in the rolling 12-month period, which is almost double the S&P 500. Technology up 44% in the rolling 12-month period. I think you can take a little profit there, reposition to some lower valuations with some really good tailwinds in those sectors. So you don't have to pull back your equity exposure materially, but I do think you need to rotate it, and we're seeing that in the breadth and the widening out of the earnings contribution, and it's not just about the narrow few that we saw the last couple years.
Do I need to differentiate what breadth actually means? Because breadth for some people means Russell 2000. Russell 2000 under pressure, it's much smaller companies with FRNs on board, a lot of debt exposure, and they are much more exposed to a rate cutting cycle relative to perhaps other core rotated sectors. Can you just dissect that for me?
Yeah, so we've been unfavorable small caps relative to large caps for probably 18 to 24 months now. We just don't see the business dynamics going well there for the reasons you just mentioned. Higher rates, tougher earnings environment, no real scale and pricing pressure in a world where pricing pressure really matters. I mean, and you can see it in the prices. Year-to-date, small, the Russell 2 is underperforming the S&P by 600 basis points. And on the rolling 12 months, it's 1,200 basis points. So large continues to best small cap. At some point, maybe there's a valuation inflection point there, but we haven't seen it quite yet. The other thing I would say about breadth too, Manny, is when you look at what's happening, so we just had 5 months in a row of positive equity performance, everybody knows, since last November. That's only happened 13 times in history, right? So it's very unusual. Actually, bonds have had a bigger drawdown in the first quarter than equities have, which is very unusual as well from a timing standpoint. And then if I go into where we are on positioning, you look at some of the bull bear surveys, the number of bears are the lowest level they've been since January of 18, and some of your hedge fund and CTA positioning is in the 99th to 100 percentile, which often are very good contrarian indicators in the near term to take a little profit, use that dry powder to reposition from the winners that you enjoyed to some of the places where there's still value in the market.
I mean, your business is the business of wealth management, and many times I catch up with Mark Haefele at UBS, different global wealth managers, and when I say, well, how do I protect myself? And we often look at, you know, using option strategies or using volatility strategies, and often I get a lot of pushback saying that's, you know, we're not in the business of wasting money, squandering money on insurance certificates. That's not from you. That's from other people. How do you play that defense? What is the belly of a defense for you in wealth management? Is it cash on the barbell, cash and tech, as State Street have?
Yeah, I think so. If you look at where we're positioned today and have been for some time, we're on the short side of the curve. When you have an inverted yield curve, you know the highest yields on the board are on the short side of the curve. There will come a time to extend duration, but it's not here, not yet. We actually think rates stay higher than most people on the street do. Our 2024 year-end target for the 10-year Treasury is 4.5%. Everybody else has a 3 in front of it if you look at the consensus on the street. So we're a little bit out of consensus there. We've been favorable on commodities, which has been a home run when you think of what oil prices have done, what gold prices have done over the last 12 to 18 months. And then we've just been more selective in the equity sector to some of those sectors we've been talking about. We've been favorable large over small, developed markets internationally over emerging markets, and we think that still plays for investors for some time and creates a good positioning environment.
Okay, thank you very much. That is Wells Fargo's Darryl Cronk on the markets. Coming up, President Biden and Xi Jinping, they start talking again.
The teams have been working a lot since November, and both presidents thought that now, a few months later, this was a good time to kind of check in with one another, see how that's going, discuss the future.
Secretary Yellen gears up for another trip to China. The conversation on the way with Ami Hordaran right here on Bloomberg.
into the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Ursula Hurley walked me through Terminal 5 at New York's John F. Kennedy Airport, where the complexity of the business she oversees really comes into focus.
We operate 1,000 flights a day. We serve over 100 destinations, and we transport about 40 million customers per year. When you think about a person booking a flight to getting them to their destination and home from their destination, it takes an army of things to go right.
There's change on the way at JFK. Ground has been broken on a new Terminal 6. It will connect with Terminal 5 and add capacity for up to 10 gates. JetBlue joins a consortium of companies managing the $4.2 billion project, helping define its design and guide its construction towards completion in 2028.
We're still in the design phase for Terminal 6, but we leverage what other airports have done and what we've seen throughout the world, quite frankly, and we're going to pick the best of everything to really elevate the game. And technology is going to be at the backbone of that journey. We want to be able to create and give customers experiences where they can self-serve as much as possible across the travel ribbon. So whether it's checking in, whether it's checking your bag, going through security, boarding a flight, we want everyone to be able to do that seamlessly and be able to do that with your own handheld technologies.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The teams have been working a lot since November on fentanyl precursors, on climate change, on economic practices. So there's been, on artificial intelligence, there's been a lot of staff level work, and both presidents thought that now, a few months later, this was a good time to kind of check in with one another, see how that's going, discuss the future.
The White House ramping up the communications with China. President Biden and Xi getting on the phone for their first one-to-one talk since November. Meanwhile, you've got Treasury Secretary Yellen heading to China this week for the second time in 9 months. Anne-Marie Hordern joins me now. So, Anne-Marie, ramping up the rhetoric. The Chinese readout was don't flip-flop on us. The U.S. readout was, of course, hitting key points that win in an election year.
Certainly, and this has to go with what the United States is calling unfair market practices, and you're going to hear potentially Secretary Janet Yellen talk about the same when she goes to China. She wants to talk about the fact that they have excess capacity, the subsidies China uses in their market, and potentially what people say are just dumping on the global market. What's interesting from this statement yesterday the White House put out after the Xi Jinping-Biden call was that they insinuated that they will make sure they are protecting their own industries, especially when it comes to national security concerns. And remember, those tariffs, when it comes to the Biden administration, are still under review. This morning, though, was looking to what Yellen potentially may say when she meets her counterparts. And she said this to the Wall Street Journal. People like me grew up with the view, if people send you cheap goods, you send them a thank you note. That's what standard economic basically says. But she said, I would never again say, send a thank you note. Remember, she came into this administration a little bit more hawkish. More dovish when it comes to China, and she's really become a lot more of a hawk.
If you look at Yellen's trip and this bilateral communication, it is about the imagery. We then cast forward and we have more rhetoric coming from the Trump campaign that they may well indeed go for much more aggressive tariffs, Anne-Marie, which will have inflationary implications. Is this a political win for Biden and Yellen if they show rapprochement versus active conflict?
I think what the Biden administration is trying to do is they met with Xi Jinping in person in November, and they're trying to keep the relationship on the rails. It is an election year, and I think from Xi Jinping's point of view, he also wants to make sure that he is reviving his economy, and that is why he sat with a number of U.S. executives recently. They have very low foreign direct investment, and they're trying to make sure that they are revamping their own industries and making sure they are still luring in the business community. So both have a win here in terms of trying to keep the relationship on the rails. The issue is, of course, the rhetoric is going to get a lot more tense as we head into November.
Of course, and we are talking about competition, we're talking about subsidies, and of course the accusations fly from both sides, as well as disgruntlement over the World Trade Organization, those multilateral organizations. Anne-Marie Hordern, thank you very much for joining us. Let's break a little bit of data with you now. We've got the US PMI data crossing the Bloomberg terminal just moments ago. Mike is with me on the studio floor. So disruptive as the ADP. What did you make of it, Mike?
Well, ADP was disruptive, but I think if you are going to trade on surprises, you're not going to be trading much on the PMIs, because the services PMI comes in unchanged, exactly at 51.7, same as last month, same as forecast. The composite now goes to 52.1 from 52.2. This is sort of like the warm-up act for the ISM services number at 10, and we will get some sort of market reaction to that, particularly for the headline and for prices paid and employment. Everybody's going to be looking at employment after the ADP numbers and after the ISM manufacturing numbers to see if it crosses 50. It was 48.0 last month. We'll see if it suggests expansion in service industry jobs.
Okay, Mike, thank you very much. Just looking at 10-year notes at the moment, we've had 19 basis points in the space of 3 days. We're now up 7 basis points on the day, 442. Again, reasserting the upside on this 10-year paper. Another challenge to the equity market. Let's look under the hood, the sector price action with Abby. She's in the seat. Abby, take it away.
Well, it's interesting, Manus, because we do have yields popping higher on the economic data. That 10-year yield, as you were just mentioning, higher by about 6 basis points. Excuse me, yes, about 7 basis points. But that's not having too much of an influence on either the S&P 500 or the sectors. You would think that the S&P 500 might be down a little bit more on the expectation that liquidity is not streaming into the market. Industrials up about 0.4%. That's the best sector. 5 sectors higher, up about that much. To the downside, the worst sector, staples down 0.6%, and then utilities. That does have to do with yields being higher because those dividends look less attractive, but not a lot of drama here going on sector-wise. Let's take a look at one subsector, though, that's really underperforming on the week, and that is the apparel and accessories index yesterday, with PVH, Calvin Klein's owner, down 23%, the worst day since 1987. We're looking at, over the last 3 days, a roughly 5.6% decline. And on the week right now, Manus, all 11 components, from PVH to Hanes to Under Armour to Capri, well, they are all down on the week.
Okay, certainly there is a bite in the consumer at the moment. Abby, thank you very much. Coming up on the show, market-moving events that you need to keep a pencil in your diary.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The deal. That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
These equity markets are shaken by higher rates. Tesla is brutally attacked. It's in the space of 2024. That is taking a chunk out of the NASDAQ. It's down over 33% so far in 2024. That is about the price of EVs. That is about the price of Teslas. That is about batteries. Overall, you see the broader market under pressure because it now lacks conviction on rate cuts. Let me just show you the bond market because this is the wall of worry that you are actually dealing with. It is this slow and gradual rise. We're now at 22 bips in the space of 3 days. The question you need to ask yourself is whether real money comes in here. Is there enough value there for real money to come in and buy? That's what RBC said to me this morning. Or is that we're about to break higher, and that's got consequences for a much bigger shift in the second quarter of 2024. Your trading diary for the rest of the day and the week looks a little bit like this. The ISM services comes out at the top of the hour. We get Fed speak galore from Goolsbee, Barr, and of course then we're counting down to Chairman Powell. The jobless claims cross on Thursday after the ADP coming in higher than expected, with wages, if you shift your job, rising by 10%. That has irked the bond market. Roll it forward, and we're wrapping up the week with those jobs report. We'll have the whisper number for you. It has incrementally gone higher through the week from 200,000 to 214,000. We will, of course, bring that to you through the morning on Friday. That was Countdown to the Open. The rest of the team take you through the trading day on Bloomberg. A very good morning from a wet and raining New York.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, you're listening to Bloomberg Intelligence. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Coming up, we're going to check in with Anthony Nieves, chair of the ISM Services Business Committee. We got some data coming across the screen as we speak. John Tucker will break it. Geetha Ranganathan, she covers the media stocks at Bloomberg Intelligence. When we get the latest on the Walt Disney Company, having a board meeting today, trying to fend off some activist investors. We'll see how that's playing out. And then Michael Stubblefield in our CEO Suite discussion. He is the president and CEO of Avantor on opportunities in the life sciences industry and what's fueling that company's growth. So it's always good to check in with people on the ground. Let's kick everything off this hour like we do with Mr. John Tucker.
All right, and we're being brought to you by Paul and Alex by Interactive Brokers. Interactive Brokers charges U.S. dollar margin loan rates from 5.83% to 6.83%, rates subject to change. Learn more at ibkr.com/compare. All right, let's start off. We are data dependent. The biggest part of the economy, services. The ISM Services Index, 51.4. That is well below expectations in the prior month. The prices paid component, 53.4. Again, that's well below the expectations there. And the ISM Services employment coming in at 48.5. While it's higher than the previous month, it is lower than expectations. As a result of that, yields were higher before this latest data. Right now, the 2-year is unchanged. The more policy-reactive 2-year, 4.69 right now. So it's moving in the right direction. Repricing of Fed rate cuts, still that was in the driver's seat for investors. We had earlier data from ADP showing companies boosting hiring last month by the most since July, and some wage gains accelerated. Meantime, Brian Levitt, strategist at Invesco, says at the end of the day, it probably is earnings and not Fed policy that matters most.
Markets had priced in 6 cuts. Now the thought is, you know, obviously we're going to have significantly less than that. Again, I've heard people concerned about that, but strong earnings and less cuts is better than the opposite, better than weak earnings and more cuts.
Yeah, real quick, Walt Disney looking to set to conclude a showdown over the composition of the board. They look to have the votes right now to defeat activist investor Nelson Peltz, and Disney shares, they were down about 0.9%. Overall, stocks have now turned. This is one of those bad news, apparently good news scenarios. S&P 500 now 13 points higher. That's up 0.3%, 52.18. The Dow Jones Industrial Average up 132 points. That's a rise of 0.3%. The Nasdaq 100 up just about 10 points. That's about 0.1% higher. Again, yields coming in right now, the 2-year unchanged at 4.69. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right. Thank you so much, John Tucker. Happy Wednesday, guys,
Happy Wednesday,
by the
absolutely.
way. It's really not awesome weather, but let's just do it.
Wind and rain and all
It's
that
just
kind of
brutal
stuff.
here in the city.
So let's just be happy. I don't know. That's not.
It's going to be a good weekend. It's going to be a good weekend.
It's going to be a good weekend. There we go. We're getting there. So talk about good weekend, bad weather. It's hard to understand, at least for me, the ISM Services Index. John was just saying, comes in a bit light, prices paid coming in light, employment coming in light, and new orders coming in light. But like some of them are still over expansion. So we got to get to the guy behind the data. Anthony Nieves is chair of the ISM Services Business Committee, and he is here with us to help break down this data. Is this a good report or is this a slowing bad report?
I look at it as being a good report, and the reason being, as we know, the baseline being 50, we're still experiencing growth month over month. So even though we had this pullback of 1.2 percentage points to the 51.4 from 52.6, activity still looks fairly strong. It's up 0.2 percentage points. And new orders, which tells us what's in the pipeline, did come down 1.7%, but again, we're north of the 50 baseline. It's at 54.4, which indicates that we'll have continued growth. As you mentioned in the prelude, that we see employment and deliveries are what's pulling down the composite index here.
So again, as we think about the services part of the economy, the major part of the U.S. economy, again, just for our listeners and our viewers, anything above 50 is expansion. So that part of the economy is still expanding. Is that the way to think about it?
Absolutely. And we're measuring change month over month. So what we're seeing is just a slowing in the rate of growth. And the employment picture continues, as I've been saying for several months now. It's a mixed bag. 48.5, it's down 0.5 percentage points. And what the respondents are indicating is that, you know, they're very cautious, and it's a controllable expense for them. And so interesting, some of the respondents indicated in their comments that even though business activity is still going good, that they're not hiring or holding back, waiting to see how things materialize in the upcoming months. Because as you mentioned about pricing still shows increases month over month. It's strong, but it's somewhat stabilizing from where it was in the past. And where we see the most volatility continues to be in the food items.
Do you get the impression when you talk to the respondents that they're going to have to look at layoffs, or is it just more about hiring more?
It's a combination, and it depends on the industry. It varies by industry within the sectors, within this sector, I should say. And, you know, certain industries like accommodation and food services is continuing to hire, whereas we know with the slowdown that we experienced in the past with real estate rental and leasing, they are not hiring.
All right, Anthony, thanks a lot. We really appreciate it. It's always good to get the details here. Anthony Nieves, chair of the ISM Business Services Committee. Again, that overall index still in expansionary territory, but definitely still slowing down just a little bit. All right, let's get to the market. Abigail Doodle, Bloomberg News Markets reporter, joins us now. Yields higher. It looks like the equity market wants to make a little bit of a run into the green here. The bad news quote, good news quote, is that what we're seeing?
We are seeing that, and I would say that we're seeing a little bit more with yields, in fact, because the 10-year yield had been up close to 7 basis points ahead of that slightly worse ISM report. And so interesting because a lot of times folks will actually ignore the ISM report so long as it's above 50 or below 50.
They only care if it's bad or like really good or something.
Yeah, but it's not even a huge. It's interesting. What it tells me is that investors are really looking for data to confirm what they want, which is in this case the idea that the Fed will in fact be cutting this year and be cutting 3 times, as was suggested by a couple of the Fed officials yesterday. But to your point on this, Alex, we also do have a move for stocks. Stocks now up about 0.3%. They had been down slightly, so not a huge move. I would say that we're still waiting for more information in terms of stock direction. But right now, a possible 3-day slide for the S&P 500 has been halted. In terms of what's moving to the upside for the S&P 500, we have GE from a point standpoint. We have Eli Lilly, Meta, NVIDIA turning it around. So earlier, of course, the chips had been under some pressure on this earthquake, the worst in 25 years in Taiwan. TSMC, the most directly impacted, as far as I can tell, in terms of having to close some plants. There had been some thought that there was going to be ripple effects into the supply chain, but it seems as though analysts are backing away from that. So NVIDIA now higher. Earlier in the pre-market, it had been down 1%. Intel, on the other hand, is the worst decliner from a point standpoint, at least. And I wouldn't be surprised. I'm going to switch it to percentage, because not percentage, but from a point standpoint, second worst from a percentage standpoint. And they are talking about losses at its factory unit widening, that it won't be profitable until 2030. So, of course, there's some turnaround hope for this stock, and, kind of in stages, I guess, fits and stops. Is that the saying? Stops and starts, basically. Some good news, bad news, good news, bad news. Today, this is a little bit disappointing for investors.
I think a lot of market participants, Abigail, were saying, given what we've done off the October lows, this market really could have a healthy 5-7% pullback. That wouldn't be the worst thing for this market.
It would be healthy.
Oh my God, everyone would love it. They get in and buy it.
Exactly, but again, we had a couple of days this week, but it doesn't. Is that kind of where? Someone like you who really looks at these markets day to day, do you agree with that?
So, in a big, steep rally, any sort of a pullback that's not massive is going to be healthy. So I'm looking at the chart right now. The uptrend for both the NASDAQ 100 and the S&P 500 is starting to break, which tells you that the buyers are really growing tired. That said, there's an interesting near to medium term line of support that is holding. So it's telling you that they're kind of hanging in there, but, really not with a lot of energy. There continues to be a bearish divergence with the RSI. Actually, let me pull that up just to make sure, because I haven't looked at that in a week. But the recent highs, this has been the case all year, the recent highs have been made on less positive momentum than last year. So the buyers have been tired for a while. At some point, it seems very likely that we're going to see, so the RSI is really trending down. There's going to be, I would say, possibly even closer to a 10% correction. And one reason, and even more maybe, just think about Apple. Apple right now down about 14% from its December high. There is fundamental news there, but at the end of the day, it's going to be the macro of the Fed, and then it's going to be the micro of the fundamentals. Yesterday was interesting because we had lots of little idiosyncratic stories to the downside in terms of Tesla and then the insurers. When that starts to be accompanied by an uncertain macro, after a massive rally, and it's not just the rally out of the October 2023 lows, it's the rally out of the October 2022 lows. There's some investors, especially those who bought well, last year or the year before, who are going to want to take some chips off the table.
All right, Abigail, thank you so much for joining us. Abigail Doolittle, markets reporter for Bloomberg News. Looking at the shares of the Walt Disney Company, off about 0.9% today, but they're up 35% year to date, far outpacing the market and their media peers. Big day for Mickey Mouse today, a board meeting, and they're trying to fend off some activist investors. Geetha Ranganathan, she joins us. She leads our media research coverage for Bloomberg Intelligence. Geetha, what's going to happen today at this board meeting? I believe it's 1 p.m. Wall Street time. What do you expect to happen here?
I think the very first thing, Paul, is they're obviously going to announce the whole voting process, who got how many votes. There've already been some press reports here suggesting that Disney might have a slight edge versus Trian and Nelson Peltz. Obviously, that's the big showdown happening today. The reports that came out yesterday suggested that more than 60% of the votes have been cast. Of course, votes can change up until the meeting that happens today at 1 p.m., but I think Disney still might have the edge.
And then what's the reaction after that? Like, are investors like, yay, we like it, or, oh, we don't care anymore? Like, what's going to be the reaction to all that?
I think regardless of the outcome, Alex, I think the pressure is very, very much going to be on the Disney board. And I think what's really clear, the reason that this whole race was so tight in the first place, obviously it got tighter once you had ISS and CalPERS kind of come out and publicly support Trian and Nelson Peltz, is that they do think that the board obviously bungled the succession issue. And that has really kind of been the rallying cry for Nelson Peltz. So I think this time the board, obviously, it looks like last time, when they went and they selected Bob Chapek, they kind of just took Bob Iger's word for it, right? Did they do a proper due diligence? Did they kind of, have a rigorous kind of vetting process? Well, obviously not. And I think this time it's really incumbent on them to kind of have a very thorough and rigorous kind of this due diligence as far as at least selecting a successor is concerned.
Is there any evidence that, I'm in the camp, being a former analyst covering this company, that Bob Iger did, in fact, really not do a good job, did a very bad job here on the succession plan. Is there any evidence that there's a new system in place, there's a new policy? Have they articulated anything to maybe get it right this time?
Yes, I think one of the things that we've seen is, Bob Iger obviously has been getting all the, these endorsements from lots of very powerful shareholders. But I think, to your point, yes, succession has been kind of this constant pain point. We have Jamie Dimon, who's kind of, shown a lot of support for Bob Iger. You have, James Gorman as well. And he's somebody that, kind of Bob Iger does consider to be very powerful. He went through this whole succession process himself at Morgan Stanley. So I think kind of having him there, and what James Gorman has kind of publicly said is that there is a better system in place this time. So I think that kind of gives some confidence that, they're looking at this issue much, much more carefully. And hopefully they won't, kind of bungle it this time around.
I mean, Musk said he would buy the shares if Nelson Peltz was elected to the board. I mean, I don't know. There's the other camp at the same time. I mean, I'm joking, but I think I'm just trying to get to, like, what would be the upside if there were some material changes on the board level, and kind of like why?
I think if for some reason, Peltz or anybody else were to come onto the board, some fresh blood, were to come onto the board, I think what it does is it doesn't necessarily change the fundamental strategy of Disney, because one could really argue that Disney has really done everything that they possibly could in terms of righting the ship, right? Yes, you could argue that there's still some issues when it comes to the content engine, which has probably kind of lost a little bit of its creative spark. But again, they are doing things to right that ship as well. Yeah, I mean, we'll have to kind of wait and watch, Alex, and see exactly how this kind of plays out.
Well, it's interesting, Geetha. I mean, you just look at the stock. I mean, again, the stock's up 35% year to date, up about 23% over the trailing 12 months. What is the market like? What is it seeing that it likes here, do you think?
A lot of different things that Disney has done. I mean, they're investing. They're investing obviously in their businesses. They're in their core businesses, the parks. There's a $60 billion plan there. They're also investing in new businesses. Remember, they made that $1.5 billion investment in Epic Games, the maker of Fortnite. So, and it's not just that. It's cost cuts across the board, and really, really heavy cost cuts that is going to boost operating income. That is kind of going to boost free cash flow. We're actually anticipating a 70% surge in free cash flow this year. And then it's the two core parts of their business, Paul. So the parks, which is 70% of their profits, is really going to be a key earnings anchor. And then it's the streaming business, which has been losing money up until this point, which is going to see this turnaround starting maybe in a couple of quarters, and then going to bring in huge amounts of profits. Not maybe nearly Netflix's level just yet, but still, a decent $1, $2, $3 billion in profit over the next few months.
All right, Geetha, thanks so much. Really appreciate it. You know what could help with that? Bluey.
Bluey?
Geetha, do you know Bluey?
I do. It's been the most watched show on Disney Plus throughout this year.
So I'm here with John Tucker and Paul Sweeney. They don't have young kids.
Oh yeah.
So Bluey is the Australian cartoon that got picked up by Disney Plus, and it is huge.
Really?
Yes, it is huge.
All right.
Are they making a lot of money off of that, by the way?
They're making plenty. Hey, Alex, it beat Taylor Swift. Okay, this is really, really huge. I mean, Taylor Swift, when she came out on March 14th, couldn't upstage Bluey. So that this is absolutely critical.
There.
I mean, I'm taking that to the bank. I'm going to use that all day on Bloomberg Radio and Bloomberg TV.
What's it about?
But okay, so we have 30 seconds. It is about a family of dogs. So Bluey is the older kid, Bingo is the younger kid, both girls, and then you have the mom and dad, Chili and Bandit. Bandit's the dad. They're in Australia, and it's just basically short episodes about that interweave the complexities of being a parent along with the complexities of growing up and being a kid in a very real, poignant, funny way. And they have cool accents because they're all from Australia. They don't have anything to say to that. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom. With this Bloomberg Business Flash, some Fed-friendly data this morning in the form of the ISM Services Index, weaker than expected, along with the prices paid component. From investors' perspective, it's ammunition to keep the Fed on track to cut interest rates. Treasury yields, they came off their highs after that report, and the major stock averages went from lower to higher. 7 of the 11 major industry groups in the S&P 500 up right now. Industrials, materials, they are in the lead. And consumer staples, we'll call this a defensive sector. That's the worst performer right now. General Electric, the best performing individual stock in the S&P 500. And at the other end of the spectrum, Ulta Beauty, the worst performing stock of the index. That right now is down just over 13%. As for the major stock averages, S&P 500, 17 points higher, up 0.3%. We're at 52.23 on the index. The Dow Jones Industrial Average up 73 points. That's up 0.2%. The Nasdaq 100 is up 63 points. That's a rise of 0.4%. And recapping those yields of the 2-year up 2 basis points right now. That's at 471. The 10-year yield, it is up now 5 basis points. That's at 440. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right. Thank you so much, John Tucker. I appreciate it. So here's a stock for you. Avantor. It's up about 10% so far this year. Done pretty well. The talk on the street is that it wants to be really a mini Thermo Fisher. So part of its business is a supplier of R&D labs for the global pharma industry, and now it's trying to make a big push into bioproduction. So that's basically the equipment of manufacturing biologic and biotech drugs. Luckily, we have the CEO and president with us to help understand what this company does, what's the opportunity, what's the margin, what's the growth. Michael Stubblefield is president and CEO of Avantor, and he joins us now from Allentown, Pennsylvania. Michael, thanks for joining. Walk us through, dumb down what you guys do for people like me and Paul.
Yeah, Alex and Paul, thanks for having me. Really happy to be here today. I think it's a great place for us to start the conversation today. We're probably one of the bigger companies that a lot of people have never heard of, and we are really ubiquitous in the biopharma space. I would say we enable innovation across the life sciences and advanced technology industries, and we really embed ourselves with our customers. We support them every step of their scientific journey. We're in virtually every research lab around the world, more than 300,000 locations. And we have a really robust portfolio, an e-commerce platform, and a whole host of productivity-enhancing services that really help the scientists at our customers develop the new therapies that you're referencing. And as those innovations advance to development and production, our materials and technologies become embedded into our customers' applications, everything from biological therapies to medical implants to electronics.
So, Michael, give us a sense of maybe who your, a common customer, or an average customer of your company. Who are your customer base, and what do they really look to you guys for?
You're really not going to be able to find too many customers that are doing work in the biopharma or the biotech space that we wouldn't be serving in some capacity. I think that's one of the more interesting aspects of our business model, is that we are deeply embedded across this space. And so it's everything from the traditional large pharma, the Johnson & Johnsons, Amgen, Novartis's of the world, all the way through to a lot of the startups and biotech companies that are out there. We have an exclusive relationship with one of the bio consortiums here in the U.S. that literally thousands of biotech startups access our products and services across that platform. So we're extremely well positioned to serve this space.
And so basically they come to you for stuff, right? Like, hey, I need this ingredient to do this thing, or I need this piece of equipment to do this thing, right?
Yeah, I'm not sure we would call it stuff, but that's
we break it down for you here, Michael.
To talk about it. So we have you can almost think about, there's nothing in a laboratory that a scientist would need that we don't supply. We have over 6 million products. That's everything from chemicals and reagents to equipment and instruments to, plasticware and glassware consumables. Think about just what a scientist needs in order to conduct their research in a laboratory. They would be able to procure from us. We look to be a one-stop shop to meet all of our customers' needs within that laboratory environment. And one of the things that we really focus on is, bringing efficiency, to our customers. A lot of the discussion in our space is how do we return time to the scientists so that they can really focus on, pushing forward these breakthrough therapies that are, really game-changing for patients around the world. And so we have, in addition to the products, a whole host of services and digital capabilities that we deploy, really all meant to improve the efficiency of how a lab works.
I'd like to ask, when we talk to healthcare companies anywhere within the space, I'd like to ask this following question. How is your business impacted by the pandemic, and maybe how is it different today than it was before? Because it just seems like that whole corner of the healthcare space really had to adjust.
Yeah, it was certainly a very interesting time from a lot of different aspects. And, I think it's important to point out that we did play a really important role in, helping address, the pandemic. A lot of our materials were being used to produce, the vaccines and as well as a lot of the materials that needed to go in to produce the test to detect COVID. But, there's probably a couple of different dynamics that I would point out that we experienced during the pandemic. First, really unprecedented supply chain constraints. There was shortages, throughout the value chain that made executing our supply chain, rather challenging. We had, significant step up in demand to support, some of these COVID-based workflows. And then as things started to normalize, of course, our industry has been facing some of the headwinds associated with just normalization of procurement and supply chain trends. So it's been a really dynamic time, but I think we've weathered the storm well, and we've offered a lot of value, during that process. Continue to focus on executing our growth strategy, and we're really pleased with how we're positioned coming out of all that.
So as I mentioned, the stock up 10% so far this year. 0 sell ratings, 6 holds, and 15 buys with a 12-month price target of about 27. We're almost there. We're like a stone's throw away from that now. I was talking to Jonathan Palmer. He's our Bloomberg intelligence guy who covers your company, and he was saying that the debate now on the street is when you can really return to growth and show some profitability improvements. When is that?
Yeah, so, one of the things that I really like about our business is just the exposure we have to some really attractive end markets. You've referenced biopharma and biotech and healthcare space, which is, more than 60% of our revenues. And when I look at the health of those end markets, I think we're quite excited about, the long-term positioning of the space, really driven by, record levels of new drug approvals, pipelines that are as robust as they've ever been, and new therapeutic platforms, whether that be, cell and gene therapy, GLP-1s that have been getting a lot of attention. And so I would say the fundamentals for our space are really robust. And as some of these headwinds that have been plaguing the industry that we just talked about, whether it be supply chain or just some of the normalization coming out of COVID, as those things subside, I think we're really well positioned to for a strong setup and to be able to leverage the momentum that's in our end markets.
So, one of the I guess just what's one of the bigger headwinds that you are facing here that you need to get your hands around to kind of move this thing forward here? I mean, again, stock's done well, but what's a key challenge for you guys these days?
Yes, when we looked at some of the things that have impacted our growth in our industry over the last year or so, it's things like inventory destocking as our customers are normalizing their inventories. Some of the supply chain constraints, whether it be access to raw materials or even just our own production capacity that we've been able to, debottleneck with investments, or some of the funding constraints in biotech and things as the capital markets have, been a bit challenged here over the last year or so. Those things have largely normalized when I look at the stability of the business in the back half of last year and into the early quarter here in 2024. I would say that things have largely stabilized, and the business, I think, is poised for a nice recovery trajectory here as we move through this year and into next year.
Before we let you go, we got Jobs Friday coming up. You got a blowout ADP. We had a super strong manufacturing ISM data. We got a good JOLTS number. How's your hiring front? Are you hiring? Are you not? What is it like to get and retain talent?
Yeah, I mean, you mentioned a lot of leading indicators there that I think we look at, and we also look at a whole host of other levels of activity in laboratories, funding, capital markets, the pipelines. I think we just kind of put all that together, and it does certainly signal I think strong momentum in our space, and has us incredibly optimistic about where things are headed. Talent is critical to us, and we're proud of the 14,000 plus associates that we have around the world that are focused on growing our business and serving our customers and helping enable some of these breakthrough therapies that are being developed. And we're continuously in the market adding capabilities, whether that be new capabilities to serve some of the new modalities like cell and gene therapy, or some of the digital capabilities around AI and automation. But we've got a global footprint. We're in 180 countries around the world, and so this is the heart of our business, our associates, and we continue to lean in to make sure that we have the right capabilities to serve our customers.
All right, Michael, thanks a lot. We really appreciate it. Michael Stubblefield, he is Avantor CEO, joining us from Allentown, Pennsylvania. That stock is up by 1.2% today, up 10% plus for the year. As I mentioned, 0 sells and 5 holds, with 17 buys, 16 buys, something like that. A lot of buys there on the stock, with an average price target over the next 12 months of about $27. All right, we're going to get much more for you over the next hour as well. We're going to cover everything related to the markets for you. We also have, speaking of drugs, Sam Fazeli.
Yes, he's in the house today.
He does all the things for Bloomberg Intelligence. Now we go to Michael Barr with World National News. Michael?
Thank you very much, Alex, Paul, John. A strong earthquake has rocked Taiwan during the morning rush hour. Today's quake killed 9 people, injured more than 900, damaged buildings, and halted train service throughout the island. William Yeck with the U.S. Geological Survey says the initial quake registered a magnitude 7.4.
We've seen numerous aftershocks. The largest was a magnitude 6.4 and occurred almost immediately after the main shock, about 10 minutes after. But since then, we've seen about 7 other magnitude 5 and larger aftershocks besides the magnitude 6 earthquake, and we'd expect to see more as time goes on.
It was the strongest quake to hit Taiwan in 25 years. President Joe Biden has issued his strongest statement of criticism of Israel's attacks on Gaza yet. Bloomberg's Ed Baxter has the story.
President Biden says Israel has not done enough to protect civilians in Gaza. This following the killing of 7 World Central Kitchen workers providing aid to Palestinians. Secretary of State Antony Blinken says the work they're doing there is extraordinary.
We've spoken directly to the Israeli government about this particular incident. We've urged a swift, a thorough, and impartial investigation to understand exactly what happened.
And the president is now also pushing for an immediate ceasefire as part of a hostage deal. Ed Baxter, Bloomberg Radio.
Special Counsel Jack Smith is frustrated with the Trump-appointed judge who's overseeing the classified documents case in Florida. The issue is whether Trump can claim that all of the classified documents found at Mar-a-Lago were his personal records. The judge has signaled that she may eventually tell a jury that Trump is right. Late last night, Smith said in a court filing, Judge Eileen Cannon's understanding of key legal issues appears to be fundamentally flawed. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Kind of a bad news, good news scenario unfolding this morning. Growth in the U.S. services sector, this is the biggest part of the economy, easing in March for a second month. You also had part of that measure of input costs slumping to a 4-year low. So it all suggests the Fed can go ahead and cut interest rates. Major stock averages, they all turned around, now green, higher on the news, and Treasury yields, they came off their highs of the day. Meantime, Eric Weil of T. Rowe Price says the Fed does risk having inflation come roaring back at some point.
If you go back to what Powell said very early on, he was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistake.
Right now, the S&P 500, 17 points higher. That's up 0.3%. We're at 52.23 on the index. The Dow Jones Industrial Average, 77 points higher. That's up 0.2%. The Nasdaq 100, 83 points higher. That is up 0.5%. The 2-year yield, which is the more policy reactive yield part of the curve, that's up 2 basis points, 471 right now. The 10-year, the benchmark, 4 basis points higher. That is at 439. And real quick, we'll do Ford. Those shares up 1.8%. Ford's U.S. auto sales rising 7% in the first quarter on strong demand for gas-electric hybrids. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. I'm Alex Steele here with Paul Sweeney. This is Bloomberg Intelligence Radio, where we bring you all the amazing work from our Bloomberg Intelligence analysts. They cover over 2,000 companies and 140 industries all around the world. And one of them is named Tim Craighead, Bloomberg Intelligence Research Director for Content. Fancy title. And the reason why is because he came up with a really great list, along with his teammates, about 50 companies to watch in January. They came up with that, and that was the ones you got to watch for this year. And they're now back with 10, specifically just for the second quarter, based on scenarios from Bloomberg Intelligence. You want to get the good apples from the bad apples, cross-sector, cross-regions, and he's here now to help us break it down. Hey, Tim, thanks for joining. Okay, so what are the top 10?
So, Alex, thanks for having me on. A couple of things to keep in mind here. Top 10 for 2Q. These are part of a broader set of focus ideas that we've got. There's roughly 75, 80 of them right now across sectors, across regions. These specifically have important catalysts coming up in 2Q that we think can bring the market around to our perspective. All of these focus ideas have really strong, high conviction, fundamental views that we think are different from the market, and these catalysts should bring that awareness around. It's a group of U.S. companies. There's 4 of them. There's 3 in Europe, 3 in Asia, and they span the gamut from healthcare, med tech products to big financials to tires. So interesting group.
And Tim, one of the ones that I've been kind of thinking about. I just think these Olympics in Paris are going to be just huge, and I'm thinking about ways to play it. You guys have one of them in the lodging space. Talk to us about that opportunity.
Yeah, we do. Accor. It's a big French hotel company. You might not know Accor, but you probably know some of their underlying brands. Yeah. And, anybody who's made a hotel booking as of late knows that the prices seem to be really high, surprisingly so. That's feeding Accor's RevPAR, their pricing, which is playing through into profit margins. And the catalyst for these guys is, in fact, the Paris Olympics. We should start to see early booking data over the course of 2Q heading into Summer Olympics. Now, Paris is only one part of their portfolio. They're across Europe and Asia, and we're seeing a strong, sustained travel recovery story that we think is better than consensus expects.
But apparently they have to like clean out the sand. Did you read that? That there's so much to
I'm not going in there.
Like, can you imagine being an Olympic swimmer and like there's garbage hitting you in the sand? I mean, they're working on it. They're definitely working on it. Okay, your second one is in retail, Chow Tai Fook. No one's gonna know this company here in the US. So tell us about it and why this makes the outlook.
Yep. So that and the next one on the list from an alphabetical perspective are both sort of interesting twists on the same underlying theme, and that's China. We all know that there's problems in China from the standpoint of the property market and how that's playing through in terms of sentiment, the wealth effect on spending plans, etc. Chow Tai Fook is arguably the best known Chinese retailer when it comes to jewelry. And it's a big market historically for tourists and travelers coming into Hong Kong and to make those purchases. In fact, what we're seeing right now is Hong Kongers are going out of Hong Kong across the border into mainland China to shop for pretty much everything because it's cheaper. So you combine that with negative sentiment, we think Hong Kong retail sales are going to disappoint, and Chow Tai Fook is a poster child. The other one, CSC Financial, is one of the largest Chinese brokerages, good old-fashioned, wealth management. And there, the investment banking business, we think, is set for disappointment because IPOs and other new stock listings are way underwater. And, we think you're going to see investment banking revenue disappoint.
I was looking through the list here, Tim, and I was looking for a name from Michael Dean and the European Autos team. And I think I found one in Pirelli Tires.
Yes, indeed. I started to say if you're an F1 fan, but that's more from a European perspective than NASCAR in the U.S.
Right.
But Pirelli is a well-known tire maker. And what they're doing is twofold. Number one, upgrading their mix. They're getting rid of some of their lower end products. And number two, they've taken on a pretty big initiative to shift production from core Europe to places like Romania over here and Mexico over there, all of which is driving better margins. And we think that this is going to continue more than what consensus currently bakes in.
Plus, it's from one of my favorite analysts over in our London office, Gillian Davis, doing some good work there.
Work.
So good stuff.
Home building. Taylor Morrison made the list. That's not normally the company you think of when you think of like a home builder, right? You're thinking Lennar, KB Homes, etc. How did this one make the list?
Yeah, I mean they're continuing to expand specifically in some larger developments in Florida and Texas, and it just seems to be a case of good old-fashioned running the numbers with those expansion plans feeding through, and their order book coming through better than anticipated, where we think there are positive surprises ahead. But it certainly is, it is a classic story from the standpoint of expanding order books, expanding volumes.
One name that's on there that's surprising, but I think it's a potential real opportunity here is Tencent. Talk to that big Chinese e-commerce, because for a lot of people, Tim, as you well know, China is kind of taboo right now from an investment perspective.
It is, especially when it comes to technology and regulatory concerns and, Beijing focusing in on, what the big tech companies are doing. Historically, these have, Tencent's driven by online gaming. And that growth rate is still somewhat muted, but there's more video that's coming through. There's AI-assisted advertising that is growing. Both of those are drivers of their income statement that we think are underappreciated. We think it's mid-teens growth going forward, but if you do the math, the market seems to be discounting basically static to maybe low single-digit growth rates, and so there it's just a case where we think the market doesn't realize that they're back to having good, solid forward growth.
Yeah, it's gonna be. I mean, it could be a really interesting story. A lot of folks, again, really not sure how to play that part of the market. Tim Craighead, thanks for joining us. Always appreciate getting your thoughts. Tim Craighead, Research Director for Content. He's also got a day job, European equity strategist, and we appreciate getting some of his times for Bloomberg Intelligence. He's based in our London office, the Queen Victoria Street offices, which are just awesome, right in the city of London, right near the Bank of England. You can't get more city of London and heart of the financial system in London than the Bank of England. And that's where Bloomberg has their offices. S&P 500 up 0.3%. NASDAQ up about 0.4%. Yields up about, call it 4 basis points, 4.39% on your 10-year Treasury. We're going to have more coming up. This is Bloomberg. Good morning.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. Some of the company stories we're following. A report from a government cyber review board says a Chinese state intrusion last year of Microsoft technology that let hackers gather U.S. officials' emails should never have occurred. This is the Cyber Safety Review Board. It's a White House mandated group designed to examine major.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age.
Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Now, I'm Michael Barr, and this is Bloomberg. John, Paul, and Alex.
I'll be Tom. Did I get to be Tom?
Bow tie.
All right.
I want to be Ringo.
Voice, Wikipedia. Okay. Thank you so much, Michael Barr. So here's an interesting piece by Simone Foxman. She is part of our equality team here at Bloomberg. She's part of our equality team here at Bloomberg. She's great.